Hi, and welcome to those who've joined already. It's still 10 minutes before the presentation is about to start, so we're just going allowing everyone in just to be ready. We'll start closest to 1. All right.
Want to start on time?
Hi everyone. We're still only not even half amount of people in yet. So we're gonna wait another couple of minutes just for hopefully everyone to start joining in now. I see the numbers are going up a lot quicker now. I gotta go attend to some admins. I see someone just registered now.
So we'll just wait a couple of minutes. Okay, shall we start?
Oh yeah, I think Stan, let's do your introduction.
Okay.
Still getting a few emails, but I'll attempt them in the background.
Okay. Thanks. Firstly, thanks, Jackie, for doing this presentation. Was interesting. Thanks everyone for joining. If you've been sending proofs of payment to my email address and you've been getting it's full, I'm having problems with Microsoft. So we are receiving some of them, but we are receiving the payment. So we will fix it up on our side. Hopefully it will be resolved soon. I don't want to delay this anymore. So Jackie, the floor is yours, and looking forward to an interesting afternoon.
Great. Thank you very much. Thank you, Stan, and good afternoon, everybody. It is wonderful to be with you again today, and looking forward to an interesting afternoon's conversation. Just get rid of that Q&A in the middle there. Right. there's quite a lot to talk about, as always, and being a mid-year update, of course, there's a lot of things that have developed. I mean, we're not going to talk about the budget speech per se, we'll leave that behind us, but we have now moved on to the phase of having legislation drafted, following on from what was announced in the budget speech. And so we're starting to get the first few batches of draft legislation coming through. Now, what's usually happened in the past is that we would get one main bit of draft legislation coming through in sort of July, and that would contain all of the provisions that we had been told about in the budget. But this year, and I guess it's indicative of the fact that there's a lot of announcements that came through in the budget, and some of them are fairly controversial and impactful, and also people are having to make decisions around these announcements fairly quickly. And so we have seen some initial releases of draft legislation, which is fairly unusual. So we've had 2 releases coming through so far. The first one, the solar panel and renewable energy incentives, that was released in April, and the due date for comment is now closed. And then we had the new 2-parts retirement system, which was released, I think it was in June. That's still open for comment just for another few days, and then that will close soon. So it's not to say that those have now been finalized, but it's the initial release, initial comment that is drawn on that release. And then those parts of the bill will form part of the actual draft bill that is released in July. So there'll be another opportunity to comment on those proposals, I would imagine, before they become final. So it is just the initial phase so that we can see where government is planning to go, especially with the solar panel and renewable energy incentives. You know, the thing is, with solar panel incentive for individuals, the window of opportunity is only for a year. And of course, we don't even have the legislation. So it's a bit tough if people are making decisions driven by the tax implications. Obviously, we need to know what the ins and outs of those tax implications are. So I will go through these 2 batches of legislation. Then we'll just go through and sort of highlight the fact that there's some changes to the dispute resolution system and just highlight what those changes are. And then, of course, the very topical thing at the moment is the 2023 filing season. So we'll probably get into that in the second part of the webinar. I'm planning to run through until, let's say, 2:30 and then take a break around about 2:30. And based on the slide numbers, it looks like we would get just before the 2023 filing season discussion. And then in the second part of the presentation, we'll get into that and then look at some of the tax judgments that have come through so far this year. Okay, so there is quite a lot to talk about, and let's get straight into it. As always, if you do have any questions, you can either just interrupt me as I'm talking and just ask a question verbally. Well, I'm not sure if you'll be able to make yourself unmuted. If you can, then great, or maybe Danny or Stan can help with that. Otherwise, just pop your question into the Q&A. That would be the easiest way of asking a question. Just pop it into the Q&A and I will try and get to it. I'll try and get to questions, you know, as we're dealing with that particular section. But if we need to come back and address questions later on, that's also fine. Okay, so just the admin then is that we'll run through until about 2:30. We'll take a 10-minute break or maybe a 15-minute break. I'll try and keep it to 10 minutes, I guess, because there's lots of sport going on, and I'm sure you're all keen to go and watch the Tour de France and Wimbledon and so on. So we don't want to run past 4 o'clock, which is our scheduled finishing time. Okay, so we'll take that little break and then we'll carry on to the second part of the webinar. Yes, somebody talking.
Yeah, that's me. I was just saying, if people do want to speak and instead of typing out an answer, they can use the raise hand feature. I'll allow them to speak and then mute them afterwards.
Great. Okay. Yeah, that's great, Danny. Thank you. Because not everybody likes to have to type out their questions. Yeah. So you're welcome to. Let's, make it interactive. I'm absolutely happy with that. That's great. So thank you. Okay. So let's go straight into then the renewable energy incentives. I've changed this name slightly because it's not just solar. The solar incentive is for individuals, but when you get to the business incentive, that is broader than just solar incentive. So you'll remember that this was announced in the budget speech, but as you also know, with tax, the devil is always in the detail, right? And so we can have the announcements in the budget speech, but it's very difficult to actually make decisions based on those announcements because you just don't know what all the terms and conditions are going to be, and those come through in the legislation. And even as we see these provisions that have been released in this draft bill, this first version of the draft bill, this initial release, there are some things that are a little different to maybe how we saw it at the time of the budget speech, but I'll highlight that as we go along. So as you know, and remember that from the budget speech, that we have one incentive for individuals, and that's in the form of a tax credit. It's a rebate. It's coming through in this new section 6C. So remember section 6, we have our primary, secondary, tertiary rebate. 6A is our medical credit. 6B is our secondary or additional medical credit. And now 6C is going to be the solar energy tax credit. But that's only going to be around for this tax year, okay, and then presumably it will disappear. So it's a temporary credit, but it's going to have its own provision in section 6C. And it's a credit for the cost that people have incurred to install new and unused. So notice that, new and unused solar panels. All right, photovoltaic. I'll have to just say PV from now on. It's just too much to get my tongue around. So solar PV panels acquired and brought into use from the 1st of March 23. So obviously we are already into this dispensation. So that's for individuals. And then businesses, here you're working on a tax deduction. So it's a deduction in arriving at taxable income. So this credit is actually a reduction in your actual tax payable, whereas the incentive is a deduction in arriving at your taxable income. And it's not just a deduction for the cost, it's an incentive in the form of 125% of the cost of renewable energy assets. And I'll go into what those assets are just now. They're used, but the assets must be used for electricity generation, and they must be brought into use by the taxpayer for the purposes of trade during this 2-year period from the 1st of March. So the businesses, 12BA has a 2-year window, individuals has a 1-year window. Now let's just have a look at the individual solar incentive under 6C. So we spoke about new and unused photovoltaic panels, all right? So the credit is calculated as 20% of the cost incurred by an individual, but capped at 15,000 per person, and it says in aggregate. The solar panels must be new and unused. They must be acquired by the individual and brought into use for the first time by that individual on or after 1 March 23, before 1 March 24. So there's that 1-year window. Now, what's interesting, and I'm just going to pause here, I said there's some things that are a little different to how we saw them at the time of the budget speech. Here you see that the solar panels must be brought into use by the individual who's claiming the credit, which is much more limited. I would hope that maybe that will change through to the final version of the bill, because I don't really see why there should be a ban on this credit being available for somebody who pays for solar panels to be installed on somebody else's residence, as long as it's a solar panel going onto the residence of an individual. But here, and you'll see it coming through again later on when I talk about the rules around the residence, it is the individual who's claiming the credit, that is the individual who's paid for the solar panels, and that is the individual who must be using those solar panels and bringing them into use for the first time between 1 March 23 and the end of February 24. And then, of course, the generation capacity, they have to have a reasonable capacity, 275 watts each. And the panels must form part of a system that is connected to the distribution board of a residence. All right, so it can't be a completely standalone portable system. Or it can't be a system that you take on your caravan. Okay, I know a lot of campuses have these solar systems, but that's not connected to the distribution board of your house. Okay, so that's the requirement, is it must be connected to the distribution board of a residence. And notice here, a residence that is mainly used by an individual for domestic purposes, but you'll see it coming through just now, that it's actually talking about the individual who's claiming the credit. So this 6C credit will apply to individuals who own, rent, or occupy residences and acquire new and unused solar panels for installation at residences that are used mainly for domestic purposes. And those individuals must incur the cost to acquire the panels. And it requires specifically that the person incurring the expenditure must acquire and bring the solar panels into use for the first time by that person. All right, so make it very clear, that person is the one who must be using those solar panels. And for natural persons carrying on a trade, and this is also something to be careful of, if you've got somebody who is working from home, they've got a business operating from their home, so they put solar panels onto the roof of that house, they plug it into the distribution board, all of that stuff actually works. But if those solar panels qualify for the 12BA incentive, or if they're qualified for the existing, or prior to March 23, Section 12B would have applied to those solar panels. Notice here, no 6C credit, no deduction. They're referring to the deduction from your tax liability, right? There's 6C. No deduction shall be allowed under this section in respect of any asset in respect of which an allowance has been granted under 12B or 12BA. So that seems to not allow this apportionment, the splitting. So if you were using the house, let's say 20% for business and 80% for residential. So it's used primarily for residential, but it's used 20% for business. Now, logic would say if you installed solar panels costing 100,000 Rand, you would take the 20% that relates to the business usage of that house, and that you would get a tax deduction for related to the solar panels. Of course, home office, there's other things that come into it. I'm not specifically talking about a home office for a salaried employee. I'm talking about someone who's running their own business from home. So let's just keep it a little bit simple there. But you would think you'd be able to get your 12B and currently the 12BA on that 20%. And then the balance, you could look at the 6C credit. But this is not allowing that. This says you can't get any 6C credit in respect of any asset which is qualified for 12B or 12BA. All right. So if you've got the solar panels on your roof and you're using that property partly for residential, partly for trade purposes, part of that asset would qualify for the 12B or currently 12BA, then you can't get the 6C on that, which to me, again, that doesn't seem to be fair, but that's the way that this draft legislation is actually worded. So we would have to watch that to see if that actually carries through to the final version of the bill. Okay, so Section 6C3 then says a solar credit will only be allowed if the solar panels are installed and mounted or affixed to a residence, mainly used for domestic purposes by the natural person. The installation is connected to the distribution board and you've got that certificate of compliance. All right, so here again is where it's emphasizing that the person who's paying for the panels, who's claiming the 6C credit, must be the one who's actually using that residence. And that must be a residence that's used mainly for domestic purposes by that natural person. So yeah, it's very limited. And as I say, that's often why we must be careful when we hear announcements in the budget speech. Be careful before you go ahead and start making financial decisions based on those announcements, because the terms and conditions that actually come into play when the legislation is put together are often much more restrictive than what we envisaged when we saw this in the budget speech. So this is much more limited, and I think one has to just be careful. Of course, some people might be saying, well, if I get the credit, I get it. If I don't, well, unfortunate, but I still need the solar panels, and that's fine. But if you're really relying on the tax credit, you need to know when you're going to be eligible for it and when not. So it must be the person who is actually living in that house that must be the one who pays for the solar panels, and those solar panels must be used really just for domestic purposes. If they're used for trade and domestic, then you're going to get your portion under 12B or 12BA, and then it would seem you not get your credit under 6C in respect of the same solar panels. All right. There's another condition here, which talks about if you sell those solar panels within a year. Now, remember that you would only get the 6C credit on new and unused. All right. So secondhand solar panels would not make the buyer of those solar panels eligible for the credit. But it seems that to further emphasize this point that we don't want to end up with a huge market in second-hand solar panels, the idea is if you dispose of your solar panels within 1 year. So remember that you had to install and bring those solar panels into use within that 12-month period, starting from the 1st of March 23 up to the end of February 24. If you sell those solar panels before 1 March 25, all right, so it's within 12 months after the end of that year of assessment, if you dispose of those solar panels that qualified for the 6C credit, other than by way of disposing of the whole residence, then you're going to have to reverse that credit. Now, bear in mind that at the end of February 2024, this will be a tax credit that you're claiming, a tax rebate, all right, under Section 6C. So it's reducing your actual tax payable. If you then sold those solar panels other than by way of selling the whole house, so you literally take the solar panel off and dispose of it, that credit that you claimed would have to be added back as an additional amount of normal tax payable. Okay, so it's not just added back to taxable income because it wasn't a deduction from taxable income in the first place. It was a reduction in your normal tax payable. So if you then sell the panels within that 12-month period before March 25, then you would have to add back your credit as an additional amount of normal tax payable. So that comes in as an additional tax liability in that subsequent year of assessment. Okay, so we're talking here, year ended Feb 24 is the year that you would claim the credit. If you sold the panels, let's say 6 months later, so that would be the year ended Feb 25, you would then, let's say you claimed a credit of 6,000 Rand for February 24, you'd have to actually add back tax liability of 6,000 Rand for February 2025. What if the panels are rented? Okay, so rental is not going to give you an eligibility for this credit, okay, because the credit, going back to what they were saying right at the beginning here, is that they must be acquired by the individual and they must be actually, purchased by the individual. Okay, so renting is not going to give you this credit. And if you buy the solar panels and rent them out to somebody else, if that's what you were meaning, that's also not going to help you because remember that the solar panels must be used on the house of the person who actually has acquired them and is then claiming that credit. All right, so that's as far as your individuals are concerned. So as I say, it's quite technical and you've got to be quite careful in terms of whether you qualify for the credit or not. There is just another provision here that I didn't mention that I should just point out, that they do provide in Section 6C. It was in Section 6C3, I think it was. They talk about if the panels are paid for by more than one person. All right. Yeah, it's actually in 6C4. It says here that if more than one person incurs the cost of the panels, then you would apportion the cost according to how much each person paid for, all right? And then you're going to calculate your credit on their respective share of the cost. So if we go back to saying it's 25% of the cost, so if you had, let's say, husband, wife, and maybe there was an elderly parent living in the house, so there's 3 adults living there, and they put in a solar system and the actual solar panels, remember that this credit only relates to the solar panels themselves. So if the solar panels themselves amounted to 90,000 Rand, it's just to put a number on it, or 80,000, let's call it 80,000 Rand. So 20% of that full amount of 80,000 Rand, first of all, would be 20,000 Rand. But now if they shared that cost, and let's say the one person paid 40,000, the other person paid 40, and the other person paid 10, all right? So the first person would say, right, 40,000 I paid, I can take 25% of that cost, which is 10,000 Rand. I can get my credit of 10,000. Second person also paid 40,000. So similarly, they would get a credit of 10,000. Third person paid 10,000. They could get 25%. So actually, so this 15,000 is per person. In aggregate, it's no single person can claim more than 15,000. But for each person, they would calculate this on 25% of whatever the cost was that they incurred. And I would expect that SARS would validate this similar to what they do with the medical credit, right? The medical credit, if you think about it, 6A, 6B, it's the person who actually pays the medical expenses that gets the medical credit. And frequently SARS would ask for proof of payment. So you'd have to prove that, let's say, the husband paid that cost or the wife paid that cost. And I would imagine it'll be a similar thing with the solar incentive. At the end of Feb 24, you can be sure SARS would carry out audits on whoever claims these credits, and they would look for a validation of proof that that individual actually paid the amount on which they're calculating their credit. And you would have to also be able to prove that these solar panels have been, of course, connected to the house. They've been connected into the distribution system. You've got your compliance certificate, and that the house is the residence that that individual is actually living in. Okay, so those things will all be checked at the end of February. Now, you may remember that when SARS, they put out a draft notice for third-party returns in terms of Section 26 of the Tax Administration Act. They've only recently finalized that notice, okay, even though the due date for EMP 501s and banks and so on to report to SARS ended at the end of May. But they've only recently finalized this notice that requires third-party returns, and they've actually removed the requirement for these certificates of compliance. So initially in the draft notice, they required that electrical contractors who are issuing these certificates of compliance will have to report to SARS as a third-party notice, similar to what banks have to do, pension funds, employers, and so on. But they've now removed that. I mean, I'm not too surprised, because I think it was just going to be a very difficult thing to implement. I think for the industry, it's something that they're just not at all used to, having to now report on everybody that they issue a certificate of compliance to. So I see that that's now come out. So they don't have to actually report to SARS, but you as an individual, if you're claiming this credit, no doubt SARS is going to ask for you to provide the certificate of compliance to prove that you did get the certificate of compliance, that the panels were brought into use during the window period, and so on. Okay, so I'm quite sure this is going to be audited very carefully comes the end of February 2024. Okay, many people are renting. Yes, Anthony, yeah, that's what I understood your question to be. So if you are renting the panels from a provider, you're not actually acquiring the panels, all right? So you're not actually, acquiring would indicate that they're becoming part of your property. So they haven't catered for renting panels on this basis in terms of this credit. I think because with renting, it's a kind of pay-as-you-go basis, whereas if you acquire the panels, you're having to put up quite a big capital expenditure up front. And that's really what this credit is alleviating, is the upfront capital cost of buying these solar panels. So the rental situation is not catered for in this draft legislation. Okay. Right, let's move on to the business aspect. So that's the credit available to individuals. If we go to the business incentive, first of all, notice that it's a new provision that they've introduced. It's not coming in through Section 12B. Now, Section 12B, of course, used to relate to farmers, but some years ago, it was adapted to also deal with assets that were installed in order to provide renewable energy. And so Section 12B did cover costs of assets that were used to provide wind farms, solar farms, and also assets that were used for biomass energy production and so on. So that provided a sort of a 50-30-20 write-off under 12B. But this 12BA is coming in addition to 12B. So Section 12B is there and will still continue, But for this limited 2-year window period, Section 12BA will be introduced. And so assets that qualify for 12BA, obviously people will look at the 12BA allowance because it's actually an incentive. It's much more generous than what the 12B is allowing you. All right, so 12BA, instead of getting the 50, 30, 20 write-off that you get under Section 12B, so 50% in year 1, 30% in year 2, 20% in year 3, 12BA is giving you 125% deduction in the first year. All right, so it's definitely a lot more attractive. Okay, so this 125% deduction applies for qualifying renewable energy projects. There's no thresholds on generation capacity. So depending on how big your budget is, you know, you can put in a massive installation. And whatever the cost is to the taxpayer on qualifying assets, the taxpayer would then get in year 1, the year in which the assets are brought into use, they get the 125%. So whatever the cost is, obviously take off VAT, because the VAT you're claiming back as an input tax credit, and the balance you claim, you take 125%, and that's your deduction in year 1. But it's only available for investments that are actually brought into use for the first time by the taxpayer, and that's between March 23 and the end of February 25, so that 2-year window period. All right, and in Section 12BA, it says in respect of new and unused assets. All right, I'll come to this as I go through the detail of Section 12BA in a moment. Now, there's also Section 12E. Now, Section 12E, sorry, is the provision that applies to small business corporations. And as you may be aware, if you qualify as a small business corporation, then you will get your Section 12E allowance. And that also allows a 50, 30, 20 allowance. In fact, if you are using the assets in a manufacturing process, you get a full 100% allowance in year 1. Otherwise, you get a 50, 30, 20. Now, 12E, they're making this amendment to say that you won't get any 12E in respect of any asset that qualifies for 12BA. All right, so even if you're dealing with a small business corporation, if you install solar panels on the roof or you put in a wind farm to generate electricity, even as a small business corporation, you would then get 12BA on that asset, the renewable energy asset, and you'll get your 12E on all of your other assets. Okay, so you don't get the 12E. There's no choice here. No 12E is allowed on any asset that qualifies for 12BA. Now let's just have a look at 12BA. So in 12BA subsection 1, this is now in this draft release, the draft bill that has been released. It says that you will get in respect of any new and unused, okay, new and unused. And then it talks about the various assets, but this is taking similar wording to what we saw in 12B, machinery, plant, implement, utensil, or article, so it goes quite broadly. But notice here, it doesn't cover your buildings unless it's a foundation that the asset is attached to, and it then has a similar useful life, then you can claim that, all right? But otherwise, it's your kind of movable assets, as it were. Although granted, you know, when you're talking about wind farms or solar panels, you have to attach them to something, okay? So in respect of these assets that are brought into use, and it talks about owned by the taxpayer as a purchaser, and which is brought into use for the first time by that taxpayer for the purposes of trade and over that 2-year period. And it's going to be used by that taxpayer, again, by that taxpayer. All right, so that again is quite restrictive wording. So the one who is paying for the asset must be the one who is bringing the asset into use for that taxpayer's trade. All right, so you can't be investing into somebody else's solar installation. If I look at this wording here, all right, it's saying that it is your trade, you bring the asset into use, and you are paying for it. Okay, and then it's going to be used by that same taxpayer in generating electricity from wind, photovoltaic, so there's your solar, concentrated solar energy, hydropower, So that's water and biomass, which is your sort of fertilizer. Okay. All right. So you can be using any of these means of generating electricity. And what it's saying is that the assets that you use to generate that electricity, the cost of the asset, you can claim 125% of the cost. And if that asset is mounted on a structure which is specifically designed to hold that asset and has a useful life similar to the asset and so on, then the cost of the foundation or supporting structure is deemed to be part of the asset, all right? As long as that supporting structure is also brought into use during this 2-year window period. Okay, so that foundation would also qualify, the cost of the foundation, if it's done specifically for that asset brought into use at the same time and so on, would also qualify for the 125% incentive. All right, so year one, you get a deduction equal to 125% of the cost of your asset. Now, normally, of course, if you look at the 12B allowance, that 50, 30, 20, you know, you get your 50% in year one, 30% in year two. If you sold the asset in year three, those allowances are subject to recoupment, and you'd get your normal Section 84A recoupment if that comes through. Now, here with 12BA, you've got a special recoupment provision. And this talks about if, again, and look at this, it's within a 1-year period, all right? Because remember, we said the asset must be brought into use during this 2-year window period up to the end of Feb, before 1 March 2025. And then if you sell that asset before 1 March 26, so again, within that 12-month kind of no disposal period, so if you do happen to sell the asset during that period, then that's 25%, that extra amount. Okay, remember you got a deduction of 125%. So that extra 25% becomes a special recoupment. Okay, so that has to be added back as a recovery or recoupment as part of your 84A allowance. All right, and then obviously the other 100% is subject to recoupment as well. So if you spent, let's say, R1 million on an asset, so you claim 1.25 million as your deduction in year one, let's say in the year ended February 2024, and then let's say that in February 26, you sell that asset, all right? It cost you 1 million, let's say you sell it for 900,000. Well, you got that 1.25 million deduction, so the 0.25, the 250,000 becomes a recoupment, okay? Then you're back to your remaining million. You've sold it for 900,000, but you've effectively claimed that million as a deduction, so that 900,000 becomes a normal recoupment under Section 84A. All right, so you'd have to recoup the 900,000 and that excess 250,000. But the excess 250,000 only becomes recoupable if you sold the asset within this period before the 1st of March 2026. If you kept the asset past that point, it would seem that your recoupment is only based on the up to the original cost. So that extra 25% deduction that you get would not then be subject to recoupment if you kept the asset past 1st of March 2026. Okay, so that in a nutshell is your sort of renewable energy incentive. And as I mentioned, you've got your incentive for individuals, which deals only with solar panels. And then that is in the form of a tax credit, and it comes through Section 6C. So if you think about it, you'll do a whole tax calculation, work out the tax per your tables, take off your primary rebate under Section 6, take off your medical credit, 6A, 6B, and then take off the 6C credit. Okay, so if you're, it might be that your normal tax payable is less than the amount of the 6C credit, well, then your 6C credit is just limited to whatever it takes to take your normal tax payable down to 0. And it's a case of a use it or lose it, like you have with the Section 6A and 6B. You can't carry that credit forward to the following year of assessment. With the business incentive, it's broader. It's not just solar. You can be using assets to generate energy in any of these forms: wind, solar, hydro, biomass. And it's a deduction, but it's more than a deduction. It's an incentive because it's 125% on the cost. Special recoupment provision if you sell within that limited period, but otherwise you would recoup just up to the original cost of the asset. Okay, so that's your solar and your renewable energy incentives. I don't see any other questions coming through just yet, so I'm going to carry on and talk about the two-pot retirement system. I see that they still call it the two-pot retirement system in the draft legislation, although personally I do think they should call it the three-pot retirement system, but you'll see even on my slides I put two pots, all right? So I'm going along with what they are referring to it as, the two pots retirement system. And I guess this is because looking forward, from the time of implementation, which is due to be the 1st of March next year, from that point onwards, there will be two pots. But my third pot is the existing one, all right? Your existing retirement investment. That is actually also a pot, as it were. But what they also want to do is, although they still call it the two-pot retirement system, in the actual legislation, they refer to it as components. All right, so pots, I think, was not really sort of formal and legal enough. So they are going to, they talk about the vested component, the savings component, and the retirement component. Now, why are we having this new reform? Of course, we've seen reforms in the retirement area in South Africa going back more than 10 years now. Going back to looking at the differences between pension, provident, and retirement annuity funds, looking at the compulsory annuitization, looking at the new Section 11F deduction that came in. All right, so we've seen quite a lot of changes in the retirement space over these years. But a continuing problem has been that many households in South Africa are incredibly pressurized financially. And we've seen a trend over the years where many people actually resign from their jobs so that they can access their retirement savings, even though they take it out as a withdrawal benefit, and maybe it's subject to the tax table for withdrawal benefits. And we know that, they have negative implications going on. If you keep taking lump sums out of the retirement fund, your tax rate keeps going up and up on subsequent lump sums. But nonetheless, people's access to their retirement savings was so pressurized that they would go through and jump through all of these hoops just to access the money in their funds. And so National Treasury wanted to come up with a system that they recognize people's need to access their retirement savings, but they also recognize the absolute necessity for people to maintain some retirement savings through until they actually reach pensionable age. And so what we see coming through with this two-pot retirement system is actually a balance. It's a trade-off. And as we hear so often in life, everything's about trade-offs, right? This is a trade-off between allowing people to access their retirement savings and preserving retirement savings through until a person gets to retirement age. So we see here that there is an enablement for pre-retirement access without having to actually resign from your fund. But on the other hand, the portion that goes into the retirement component has to stay absolutely preserved until you get to retirement. So we're now going to see that you're going to have a savings component, which is accessible, and you've got a retirement component, which is not accessible until you get to retirement. And furthermore, that retirement component under the new system is 100% annuitized. So you have to take that only in the form of an annuity. There's no lump sum that can be taken out of that. So under the existing system, just to get our minds on the existing rules, under the existing rules, pension, provident, and retirement annuity fund, we now have the compulsory annuitization, right? Whatever your fund, and I'm talking about defined benefit funds now, defined contribution funds. When you get to retirement, the balance in that fund is your entitlement, but you could only take a maximum 1/3 as a lump sum, and the other 2/3 have to be converted to an annuity, or you can purchase an annuity. There's different ways that you can take the annuity, and it can even be a life annuity, a living annuity. All right, but the idea is that you've got some element, one portion, up to a maximum of 1/3 can be taken as a lump sum, and then at least 2/3 has to be taken as an annuity. So that's a compulsory annuitization that we have currently. Going into the new system, whatever's in your savings pot, you can access, you can take that, you can take it as a lump sum if you like, you can take it every year as you go along, but whatever's in the retirement pot is preserved until retirement and has to be taken by way of an annuity on retirement. But as I say, the third pot is your existing investment in the retirement fund going up to the end of February 24. That will be what we call the vested component. And I'll talk about how that's treated, because the vested rights will be protected. You will still be subject to the existing rules on that vested pot, even if you only retire in, say, 10 or 15 years' time. Right. Now, the first batch of legislation on this whole new two-pot retirement system was released in 2022. Initially, they were going to implement this new system from March 23, but they've now postponed it to the 1st of March 24. I'm seeing some people even saying, well, I'm not even sure it's going to really happen in 2024. But 2024 is the planned implementation date, and that's the implementation date that's actually stated in the draft legislation. So we had this first batch that was released last year. There were still a few things that had to be tidied up. That has now been addressed, and they've now released the second batch of draft legislation. It was released in June, and it's open for comment until the 15th of July. All right, so you can still comment. Anybody can comment. Obviously, it probably helps to route these comments through your RCB, your professional body, or one of the large firms. Usually these are the types of institutions and entities that actually comment on the legislation. But yes, it's still open for comment until the 15th of July. Now, in the course of releasing these amendments in June 23, they released two draft bills. The Draft Revenue Laws Amendment Bill, and that contains the aspects that we are familiar with as far as the tax law is concerned. And then also the Draft Revenue Administration and Pension Laws Amendment Bill, which is quite a mouthful, but that really contains the amendments to the Pension Fund Act. All right, and so the actual specific pension laws, these are the amendments that go in theirs. All right, so I'm really going to talk about the Draft Revenue Laws Amendment Bill, talking about the amendments to the Income Tax Act. And there we look at the definitions of pension fund, provident fund, retirement annuity fund, and of course, looking at the second schedule, because the second schedule tells us what the rules are to determine the amount that actually becomes taxable. And then, of course, we talk about the lump sums being taxed according to the special tax tables, and annuities, of course, come into gross income. But that second schedule, of course, has to be amended for the new reform that's taking place. So just a broad overview of this new system. So as I mentioned, it's due to be implemented from the 1st of March 2024. And these are three pots: savings, retirement, and vested. But going forward, they're really just looking at these two, the savings component and the retirement component. So what will happen is that your contributions going into the funds from the 1st of March 24 onwards, 1/3, and this will happen automatically, you don't have a choice on this, 1/3 of your contributions will be allocated into the savings component, 2/3 will be allocated to the retirement component. And I'll give more information on this, but just very broadly, the savings component will be available to be accessed before retirement if you want to. Of course, it's not really advisable, because if you keep drawing out your savings component and spending it on overseas holidays or new decor for your house or whatever the case might be, you're going to get to retirement and find you only actually have 2/3 available. So that's quite a severe depletion. and would put you under quite a lot of pressure in terms of whether you have sufficient funds available for retirement. But of course, the counter argument is, well, a lot of people take their funds out of their retirement funds before they get to retirement anyway. So this is just sort of making it very prescribed in terms of how much goes into savings, how much goes into retirement, and you simply cannot access the retirement component until you get to retirement age. So even if you change jobs, possibly even if you get retrenched, all right, you probably would not be able to access this. There will be some rules around retrenchment, but in the ordinary course of events, you would not be able to access your retirement component until you get to retirement. But as I say, you're vested, and that's whatever's gone into your funds up to the end of Feb 24. That is still subject to the existing rules, and I'll talk about that a little bit later on. So in terms of the policy system, the policy design of the new system, we still talk about an EET system, exempt, taxed. So exempt, the first E for exempt talks about the fact that the contribution that you put into the retirement fund, that is tax exempt. You know, we get a tax deduction, right? So that's an exempt portion. It's a non-taxable portion that goes into the retirement fund because you get your deduction under Section 11F, and at this stage 11F remains unchanged. So that's the first E. The second E is the exemption within the funds themselves, all right? Some of you might remember we used to have retirement fund tax back in the day. Fortunately, they scrapped that after a few years. And so the funds within the retirement fund themselves, those investments build up tax-free. All right, so that's the second E. So the first E is what goes into the fund. The second E is within the fund exempt. When does the tax happen is when you take the money out of the fund. So that's that T over there. Whether you take it out as a withdrawal benefit, get taxed according to the withdrawal benefit lump sum table, or you leave the money until you retire, and then you take out lump sum benefits and annuities. There are different tax treatments that apply, but there is tax on those amounts when they come out. Of course, subject to the 550,000 Rand initial amount that is exempt in terms of lump sums, but thereafter the balance would be taxed. Okay, so that EET system remains, and 11F is still there, still has the same restrictions, and at this stage would seem to remain unchanged. We will have some second schedule amendments, as I mentioned earlier, second schedule measuring and putting rules into place in terms of how much of your retirement benefit is actually taxed, and also dealing with tax-free transfers from one fund to another. All right, we'll talk about tax-free transfers a bit later on. And then rules for taxing withdrawals. Okay, currently, if you are a member of a fund and you withdraw money, so you've got to resign from your employer, take the money out of the retirement fund before you get to retirement age, that's a withdrawal benefit, all right? And that's subject to the special tax table that applies to withdrawal benefits. Going forward, there's special rules that apply if you take money out of your savings component, and it's a totally different tax treatment, which I'll explain just now. Now, there's also, because the funds have to withhold tax on the withdrawals from the savings component, there's fourth schedule amendments that come into play to enable the funds to do that. And they would have to get a tax directive from SARS, and they would then have to apply tax to whatever's taken out of the savings component. So let's go on and have a look at these three different components, all right? So I'll look at the savings component, then I'll look at the retirement component, and then I'll look at the vested component. And then I'll look at other aspects like tax-free transfers and seed capital and things like that. Right, so what I suggest is maybe just hold off your questions until I have completed the whole discussion, and then ask your questions, because you may well find that if you have a question on, say, seed capital and so on, I will come to that. It's just going to take me a little while to navigate everything. So bear with me, and if you have questions at the end, then please pop those into the Q&A box. All right, so the savings component. Now, as I mentioned, if this system is implemented from the 1st of March 2024, from that date onwards, any person who's contributing into a retirement fund, So those retirement funds that we have identified an approved fund in the Income Tax Act, your pension, provident, retirement annuity. We also have the various preservation funds. But if we're talking about your active members, so your contributions going into pension, provident, retirement annuity fund, from the 1st of March 24 onwards, automatically 1/3 of your contributions will be allocated by the fund into a savings component. So they will actually open up a savings component and a retirement component. And 1/3 of your contributions will be allocated by the fund to the savings component. And the important thing here is that this savings component will be accessible. So the member may take their money out of the savings component at any stage, all right, without having to resign. But they can only make one withdrawal per year, all right. So you can choose maybe at the end of the year, whatever you've put into the savings component, you want to take out again. Or maybe sometime during the year, you can take out, but you can only make one withdrawal from the savings component per year. Okay. And your minimum withdrawal amount is 2,000 Rand. That's a gross amount before tax is taken off, all right? And there's no maximum. Whatever's in your savings component, you can take out. If you did not take anything out of your savings component in year 1, you could choose to take whatever's there in year 2. All right, so the savings component does build up from year to year, and it's not cleared out at the end of every year. So each year, 1/3 of your contributions goes into the savings component, and you can take out whatever amount you want to, up to, of course, what your balance is, subject to the fact that you can only make one withdrawal, and it's got to be a minimum 2,000 Rand. Okay, so you can't take 500 Rand. Obviously, the admin for the funds just becomes too much. So they've said minimum 2,000 Rand, but you can take the whole amount if you want to. But notice this. Any withdrawal from the savings component will be fully taxed. Now, it makes sense because as you've been making your contributions into the funds, your retirement fund contributions, you get your 11F tax deduction, which can even be taken into account by your employer when they work out employees' tax. And so you would get your tax deduction, let's say, every month when you're doing your contributions into these funds. And so if you then get to some point during the year and you take the savings out, then you can look at it as being a type of a recoupment of a past deduction. All right, so whatever you take out of that savings component effectively becomes a recoupment, and that's going to be taxed at your marginal rate. So the reason why they say tax at your marginal rate, because it becomes income. And so you add that on top of what other income you have, and so effectively it's taxed at your marginal rate. And the fund has to withhold the correct amount of tax according to a directive from SARS. So they have to actually apply to SARS for a directive to work out how much tax they have to withhold, and they must then withhold accordingly. Okay. Should a member not make a full withdrawal within a year, then your balance can carry over, and you can effectively, you could leave your savings component for 5, 10 years, whatever, and then you feel that you need to access it, you can access it. But bear in mind that if you have been putting small bits into the savings component year on year on year, and now let's say you've got 100,000 Rand in that savings component after 10 years, now you take that out, that's going to be 100,000 taxable income that's going to be added onto your other taxable income. And so you're going to pay possibly quite a high tax rate on that 100,000 Rand. All right, so that's something to bear in mind, is the fact that whatever you take out of that savings component becomes fully taxable, and the fund has to withhold the tax before they pay those savings back to you. All right, so it's not a case of being taxed according to a special tax table. It's just taxed as income. You get your deduction for your contributions going in. When you take your savings out, it's just additional income that gets taxed, but it's going to be taxed according to directive, and the fund has to take off that tax. Now, there would be the possibility that at the end of each tax year, you could transfer your savings component to the retirement component, and that would put, of course, that savings component out of temptation's way. But once it's into the retirement component, that's it. You can't transfer it back again. All right. So some people might say, well, I might prefer to just leave it in the savings component just in case I ever need it. But if you really don't want to do that, you can put it into your retirement component, and that would be a tax-free transfer. Now, once this person has contributed into the savings component, remember 1/3 of their contributions each year automatically allocated to the savings component. If they then resign, let's say they've already made a withdrawal during that particular year, and you can only allow normally one withdrawal per year, right? If they've already made a withdrawal that year, well, whatever's left there, if it's up to 2,000 Rand, they can clear out that balance because it's a kind of a de minimis amount there, all right? So any remaining savings up to 2,000 Rand could be withdrawn as a second withdrawal. All right, so ordinarily you can't just take us as a second withdrawal because you already had your one withdrawal for the year. So you can only then take out up to that de minimis amount as a second withdrawal. And any remaining savings balance can then be transferred to another savings component in another fund, or it can go across to a retirement component in another fund or in that fund free of tax. So if this person was saying, well, I'm not going to take out my savings on an ad hoc basis, I'm going to only wait until the end of the tax year, and then whatever I've got in my savings component, maybe I'm going to draw it out. So this person resigns during the year. They haven't yet made a withdrawal from their savings component. They could then, of course, make their one withdrawal, could be the balance of the savings component they take out at that stage, but it would be fully taxed. Okay, so this is just saying if they've already made a withdrawal, there's a limited possibility to make a second withdrawal on resignation, but then it's only if you've got a remaining balance of less than 2,000, and then you can clear that out as part of that de minimis arrangement. All right. On retirement, so if you've kept building up in your savings component and your retirement component, you actually get to retirement age. You've now got these two different components. Any balance in the savings component you can take out if you want to at that stage, but that's going to be a normal drawing out of the savings. It's going to be fully taxed at your marginal rate, just like any other drawing out of a savings component. Or you can transfer that across to your retirement pot, and then that is a tax-free transfer. Now you've bolstered your retirement pot, but remember that your retirement pot can only be taken as an annuity. All right, so that becomes a little bit more onerous, because currently we've got a possibility of 1/3 lump sum, 2/3 annuity, lump sum taxed according to the special lump sum benefits table, all right? But here, this is not taxed according to the special lump sum benefits table. This tells us that if you take out from your savings component at any stage, even right up to on retirement, it's going to be a fully taxable withdrawal, all right? Tax at your marginal rate. And then only the balance going into a retirement component, but then you take that as an annuity, and of course annuities become fully taxable, right, in terms of the gross income definition. Unless under 11F, you have contributed, your deduction is less than what you've actually contributed to the fund, then those excess contributions that didn't qualify for deduction still becomes a tax-free portion either of your annuity under Section 10C or your lump sum, if you've still got some vested component and you take portion of that as a lump sum. Now you can see already, some of you are probably getting a bit cross-eyed at this stage and thinking this is starting to sound rather confusing. And I think it is quite complicated because you're now merging two different systems, all right? The existing system dealing with your vested pot and the new system. And there is a distinct possibility that over the next couple of decades, you're going to have people who are retiring who have been participants in both systems, all right? And it is going to get fairly complicated. In fact, it's complicated even further by the fact that when we looked at our provident funds and we brought them into the compulsory annuitization system from March 2021, we had members who were over the age of 55 who did not have to come into that compulsory annuitization system. So they've got a separate set of rules applicable to them as well. All right, so yes, it does get complicated, and you've got to kind of keep your wits about you with this lot. Anyway, we're talking about the savings component, and we said what happens on resignation, what happens on retirement, what happens on death. The member's interest in the savings component can be paid across to their nominee or dependent, or otherwise it would go into the estate of the deceased person, and that would be as a lump sum, taxed as a lump sum benefit, or transferred to the retirement component and paid to the nominee or dependent as an annuity. Then the other possibility is, of course, this issue around ceasing to be a resident, being able to take out your money from your funds before retirement age when you cease to be a resident. Now, remember that in terms of the current rules, if you wanted to take a pre-retirement withdrawal out of your funds on ceasing to be a resident, you could only actually access that money once you have remained a non-resident for at least 3 years. Okay. Now, if you've got somebody who ceases to be a resident, and we're now in the new dispensation, and they've now got a savings component and a retirement component, they cease to be a resident or they leave South Africa on expiry of a visa. If they take the money out of their savings component, well, it's going to be the same treatment as anybody else. Yeah, you can take your money out, just like anybody can take their money out of their savings component at any stage, but whatever you take out becomes fully taxable, taxed effectively at your marginal tax rate. So that's effectively your savings component, all right? Then your retirement component, which is the second pot. So there's two-pot system, savings component, retirement component. From the implementation date, 1st of March next year, automatically 2/3 of a person's total contribution will be allocated by the fund into a retirement component. And that retirement component, as I say, untouchable, you cannot access it until you get to retirement age. On retirement, you can only take that component in the form of an annuity, which could include a living annuity. It has the same annuity possibilities as we currently have. Now, we also currently have a limitation to say that if the amount available for an annuity is less than 165,000 Rand. So that's 2/3 of the total amount, because currently we say under the current law, 1/3 can be taken as a lump sum, 2/3 as an annuity. So we say if 2/3 of the total amount, the amount available for an annuity, would be less than 165,000 Rand, then it's not financially feasible to take an annuity. And they're saying that this same de minimis amount will apply. All right, so if the amount available for purchasing an annuity, 165,000, if you don't have that much in your retirement component, then you would not be obligated to take an annuity. All right. And they say the ability to commute an annuity will be determined with reference to the member's interest in their vested component and retirement component, and will be determined on a per fund basis. Now let's have a look at the different options here. So when you've been contributing to the fund, 1/3 went to savings, 2/3 went to the retirement component. If you then want to resign from that fund, remember that retirement component cannot be accessed until retirement. So you'd have to transfer that retirement component to another retirement component. So that would be either in a new fund or in a preservation fund. It would have to go into a retirement component. So it would be held there for you. It would continue to accumulate investment returns, but you can't take that money out of the fund until you get to retirement. All right, and then it has to be taken by way of an annuity. On death, the member's beneficiary would continue to receive the annuity from the retirement component. And if a person ceases to be a resident, and we spoke about the fact that they want to take their money out of the fund pre-retirement age, all right, before they get to retirement, and they say, well, I'm ceasing to be a resident, remember that 3-year rule, you've got to remain a non-resident for at least 3 years, then you can take the money out. And interestingly here, because you're now taking the money out and it's not being converted into an annuity, and you're not taking money out of the savings component, so it's not fully taxed. So here they've said that taking out of the retirement component, it will be taxed as a lump sum withdrawal benefit. So now we're going back to the lump sum withdrawal benefit tax tables. that we have in existence at the moment. And so that's actually effectively the same treatment as what we have currently if you have a pre-retirement withdrawal from a fund when a person has remained a non-resident for at least 3 years. Now, in your fund at the end of February 2024. Okay, so let's say that you've been a member of a fund for a few years, you've been contributing, and we know what the existing rules are. And so you've then got a balance at the end of February 2024. That becomes what we call the vested component. You cannot keep adding to your vested component, all right, except for a small group of people that I'll come to just now, those over 55 members of provident funds. But for everybody else, your vested component, you cannot continue to contribute after the implementation date of the new system. So after the implementation date of the new system, your new contributions will go to savings component, retirement component. But of course, your vested component is still there within the fund, and that will still remain invested by the fund, and they'll still continue to get investment returns on that vested component. But the current rules will always apply. So the vested rights are protected. Okay, so the vested rights arising as a result of the annuitization reform will be retained. That's that compulsory annuitization that came into effect from the 1st of March 2021. So all funds, have compulsory annuitization. And then vested rights relating to the vested component and the rules that apply under the current regime will continue to apply. So if you've got a vested component, let's say you've got a couple of million rand invested in a retirement fund, that continues to accumulate, but you can't keep adding contributions, all right? But it continues to accumulate with investment returns. And let's say you retire in 10 years' time. Whatever the balance in that vested component is at that stage when you retire, you can take 1/3 as a lump sum, and 2/3 would have to be converted to an annuity. So that 1/3, 2/3 compulsory annuitization story will continue to apply to the vested component. But notice you can't make any further contributions to this component after the 29th of Feb, except for members of a provident fund who were already 55 years of age on the 1st of March 2021. Because that group of people, they had already reached 55 years of age when we moved to the compulsory annuitization. And remember, provident funds did not previously be subject to compulsory annuitization. They were then moved into compulsory annuitization from March 21. But again, there was a protection of vested rights for people who had already reached 55 years of age. So if you had a person who was 55 years of age on the 1st of March 2021, a member of a provident fund, when they retire, maybe they're only going to retire, they're going to turn 65 in 2031, all right? When they retire, they can still take their full amount of their investment in the provident fund as a lump sum, all right? They're not limited to the 1/3, 2/3 story like everybody else, all right? And so it's that group of people who could, because they really are a class alone, okay? They would be able to still contribute, and they can still take their whole amount when they retire as a lump sum. But those are only, just to repeat, that's only members of a provident fund who were already 55 years and older on the 1st of March 2021, and they remain a member of the same fund. Okay, now let's look at the vested component for everybody else. So on resignation, you've got your vested component, you've got your savings component, you've got your retirement component. Now, you could transfer your vested component into another vested component, take it over to a preservation fund, and you don't have to then take it to a retirement component. You can keep it as a vested component because you want to keep your vested rights as far as that component is concerned. So you can transfer that tax-free. On retirement, as I say, the existing rules apply. Your vested rights are protected. You can take up to 1/3 as a lump sum, 2/3 as an annuity. And as far as this annuity is concerned, you've got the 165,000 day minimus. So if your amount available to purchase an annuity is less than 165,000, then you could take the whole amount out as a lump sum you're not obliged to take an annuity using an amount that's not financially viable to do so. All right. So when you work out that 165,000, whether you have actually reached 165,000 on your vested component, that is on a cumulative basis. And so you would have to say, what is in my retirement component plus 2/3 of my vested component, because that's the amount available for annuity, for an annuity. And so you take the whole retirement component plus 2/3 of the vested component. If that in total does not exceed 165,000, well, then it's not viable to take an annuity. So you could take the whole amount as a lump sum in that case. Of course, as far as your vested component is concerned, whatever you take as a lump sum on retirement is going to be taxed according to the lump sum special tax table. Okay, first 550,000 cumulative amount, lifetime amount is tax-free, and then thereafter you taxed at progressively higher rates. On death with your vested component, well, that could go to the member's beneficiary, okay, or it would go into the state. And then going to this issue around people ceasing to be a resident or leaving South Africa at the expiry of a visa. So there we're talking about somebody who wants to access their retirement funds before they've got to retirement age, and they've got this vested component. So they can withdraw the vested component as long as they've met that 3-year requirement of being a non-resident for 3 years. They can then say, right, I want that vested component. They take it out and it's taxed as a withdrawal benefit. So according to the existing rules as we have them. Okay, now just to repeat that issue around a member of a provident fund who is 55 years or older on the 1st of March 2021. So they pretty much remain unaffected by all of these rules, okay? They can continue making contributions into their vested component until they either retire or leave the fund. And if they keep contributing to that vested component, well, when they get to retirement age, they can take the whole amount as a lump sum if they want to. They're not subject to any compulsory annuitization. On the other hand, if they do want to participate in the new two-pot system from the 1st of March 24 onwards, they can say, right now, going forward, I now want to allocate my contributions 1/3 to savings, 2/3 to the retirement, and then slot in like everybody else. But that's entirely their choice. They're not obligated to do so. They can opt, and they'd have to notify their retirement fund if that's the case, that they want to go into the new system going forward, but they're not obliged to. All right, so there's special tax treatment for those people. Now, there's also a new provision, when I say new compared to what was in the 2022 draft legislation, they're now dealing with this thing called seed capital. And this is quite an important aspect. So anybody who's in the retirement system and you've got a balance in your retirement funds, remember going up to the end of February 2024, that becomes your vested component. But they are saying that 10% of whatever your vested component is, but up to a maximum of 25,000 Rand can be made available. In fact, they say will be made available in the savings component as seed capital. I would imagine that your funds would give you the option. Do you want to take 10% of your vested component up to a maximum of 25,000 across to the savings component? In other words, you can access that from the 1st of March 2024. So let's say that you had a vested component of R1 million, all right? That's a balance in your fund at the end of Feb 2024. 10% of that is 100,000, but you can only transfer a maximum of 25,000 across to the savings component. So you could say, yes, I want to transfer that across, and you can then access that. Bearing in mind, though, that you can only make you can only access your savings component once. You can only make one withdrawal from the savings component per year of assessment. And also bear in mind that whatever you take in becomes fully taxable income. All right, so you tax at your marginal tax rate. Okay, so that'll be taxed just like any other withdrawal from the savings component. In terms of defined benefit funds, there the rules are a little bit different because there you're talking about actuarial valuations of the fund, and the person's benefit that they take on retirement is based on a percentage of their final salary depending on how long they've worked for that particular employer. So the rules are somewhat different, but nonetheless, they are looking at bringing defined benefit funds into this new regime as well. It's just a question of how they will calculate the split between the 1/3 savings and the 2/3 retirement component. All right, so they'll calculate the 1/3 contributions to the savings component. That will be with reference to 1/3 of the member's pensionable service, and 2/3 going to the retirement component, they'll calculate with reference to 2/3 of the member's pensionable service. So oftentimes what they'll say is that your final pension is, let's say that maximum possible years of working is, say, 40 years. If you worked for that employer for 30 years, then your final benefit is 30 over 40 multiplied by a certain amount that's worked out by an actuarial valuation. So your final pension is based on your years of pensionable service. All right, so that's why they do the 1/3 to the savings component based on your pensionable service, and the 2/3 to the retirement component also based on the pensionable service. All right, so there'll be a separate kind of more actuarially based calculation for your benefit funds. There will also be a seed capital for the defined benefit fund. So there will also be the possibility of taking a percentage from your vested component and putting that into your savings component so that you can access it going forward. As far as arrear contributions, they will still allow arrear contributions to be made into a fund. And if they relate to a pre-implementation period, so prior to 1 March 2024, then those contributions will be allocated to the respective pre-implementation period, all right, to the vested pot, as we talk about it now. And if it relates to a post-implementation period, then it'll be allocated according to the savings and retirement accordingly. So 1/3 to savings, 2/3 to the retirement component. Then there's also, as far as retirement annuity funds are concerned, there's another special exemption that will apply to this specific type of retirement annuity funds. And they've got a new definition of legacy retirement annuity fund. And this is retirement annuity funds where you really are investing into a life policy. All right. And it's not a blanket exemption for all retirement annuity funds. It's only retirement annuity funds that meet the definition of being a legacy retirement annuity fund according to this definition. And if you were a member of such a fund before the 1st of January 2022, okay, so that's even going back to the beginning of last year, then you would fall outside of the two-pot system. All right. And that would be separate treatment. But there's obviously a very limited number of retirement annuity funds that would actually be legacy retirement annuity funds. You'll see here they have to have the following features. They must have a pre-universal life policy or conventional policy with or without profits, universal life policies with life and or lump sum disability cover, and a reversionary bonus or universal life policies as defined or referenced in the insurance legislation. Okay, so your retirement annuity fund would obviously tell you if they are a legacy retirement annuity fund as defined, and then they would fall outside of this new two-pot system. In terms of your tax-free transfers, and this is where we look at the second schedule, paragraph 6B, it talks about when you can transfer from one fund to another or one pot to another tax-free. So when you talk about intra-fund, within the same fund, now you might already be a member of XYZ pension fund, and you've got a vested component, the balance at the end of Feb 2024. Thereafter, you've got your savings component and your retirement component. So within that fund, you can transfer at any time, all right, as tax-free transfers from savings to retirement component, and from your vested component to your retirement component. But notice it's one directional. You can't transfer back from the retirement component back to the savings or the vested. But if you want to, at the end of every year or at any stage as you go along, you want to say, no, I don't want a savings component. I'm going to rather transfer that to the retirement component within the same fund. That's absolutely fine. That will be a tax-free transfer. And if you want to transfer your vested component to a retirement, notice you can't transfer it to a savings, but to a retirement component, you can do that tax-free. The only way that you can transfer into a savings component is that seed capital idea, where you can get 10% of your vested at the end of Feb 2024, up to a maximum of 25,000, that could go into the savings component, all right. But if you draw it out of the savings component, it's going to become fully taxed. Okay, but otherwise the only other tax-free transfers within the same fund is if you're going to push it into your retirement component. And then of course you cannot access that money until you actually get to retirement age. And they do make this note that the ability to make either intra or inter-fund transfers will be subject to the fund obtaining a tax directive. Okay, so even for doing a tax-free transfer, the fund would have to get the tax directive. In terms of inter-fund transfers, tax-free transfers from one fund to another, that would be when you resign or you retire from a particular fund. So if you resign and then your savings and retirement component gets transferred to another fund, that would be a tax-free transfer. And similarly on retirement, if you transfer to another fund, that would be a tax-free transfer. If a member chooses to make an inter-fund transfer of all components, if they want to do an inter-fund transfer, all components must be transferred. Okay, so you can't do just some and not the other. Everything must be transferred if it's going to be a tax-free inter-fund transfer. So the following inter-fund transfers will be permissible as tax-free transfers, as long as you transfer all the relevant components. So you can go from the transfer raw funds savings component to the transfer refund savings component. So let's say you resign and you've got a savings component. You can transfer that savings component to a preservation fund savings component, that would be the transfer refund, or the preservation fund's retirement component. So from savings, you can go to another fund's savings or retirement. From your existing fund's retirement component, let's say you resign, you need to transfer that across. You can transfer that to the new fund, the preservation fund's retirement component. Okay, lost my place there. There we go. And from your vested component in your existing fund, if you resign and you transfer across to a preservation fund, you can transfer that vested component to another vested component in the preservation fund or a retirement component. Okay, so they're quite, they're fairly logical in terms of how these transfers can work. And then, of course, you can transfer these amounts tax-free, but you can't. For example, if you have a retirement component in your existing fund, you have to transfer the whole amount, all right? So all of the relevant component to the new fund in order for that to be a tax-free transfer. Now, they do give quite a nice example in the explanatory memorandum to the draft legislation, and I'm just going to go through this example quickly. So you have a person who's employed, and they currently have 200,000 in a provident fund. That's their vested component, all right? That's the balance at the end of Feb 2024. Then the two pots regime comes into play. And from there onwards, 1/3 of the contributions goes to the savings component, 2/3 goes into the retirement component. Okay, so after 2 years, end of 2026, so you got 2025, 2026, with this allocation between savings and retirement. So you had your vested component of 200,000, which has now grown with some investment returns. It's now sitting at 220. And your new contributions going into the savings and the retirement, you've now got 20,000 in the savings and 40,000 in the retirement component. So at that stage, they could withdraw the whole amount, whatever's in their savings component, they can withdraw. They don't have to resign in order to gain access to that money. But remember, you can only make one withdrawal per year. Any amounts withdrawn from the savings pot fully taxed. And as he has not resigned from employment, no further withdrawals can be made until the following year of assessment. So if he even decides he wants to withdraw, say, 10,000 Rand, and might be July of that particular tax year, well, he's now done his one withdrawal for that year. So even though he hasn't withdrawn everything, he's done his one withdrawal. So he can't take any more out for that year. He'd have to wait for the following year. So only one withdrawal permitted per year. Now, let's assume that this person did take 20,000 out of the savings component. All right, obviously can't touch the retirement component and can't touch the vested component until they get to retirement age. Now, after another 2 years, they've now got 25,000 in the savings, they've got 100,000 in the retirement component, and 250,000 in the vested component. This vested obviously just growing with investment returns. Now A wants to resign and join another company. So he's leaving this fund. All right. So when he leaves this fund on resignation, because he hasn't reached retirement age, he could take the whole savings component. All right. Or he could transfer that across to another fund and would go to a savings component in the other fund. So he can either take it out or transfer it. If he takes it out, he gets fully taxed. If he transfers, it would be a tax-free transfer. On the retirement component, he'd have to transfer that to the new fund. On the vested component, because this can be taken as a withdrawal benefit because he's resigning, if he took it as a withdrawal benefit, it would be taxed according to the withdrawal benefit tax tables. But on the other hand, he could transfer that across to a vested component in the new fund. The other point is that if he transfers the savings component across to a new fund, that remains accessible, all right, subject to the 1 withdrawal per year rule. Okay, so for the vested component, as I've mentioned, he could withdraw it, he could transfer it, and if he transfers that amount, he can either transfer that amount to another vested component, or he could transfer that amount to a retirement component, in which case it's then locked into the retirement component. Let's say that he then goes on for another 10 years and then he gets to retirement age. And at the time of getting to retirement age, he has 75,000 in the savings component and 600,000 in the retirement component. He has no vested component because back here, he may have opted to transfer his vested component into the retirement component. So he now has 600,000 in the retirement component, 75,000 in the savings. He can take the 75 out of the savings, but that'll be taxed as normal income. Alternatively, he can transfer that into his retirement component, and that would boost, obviously, the amount of money that is available to purchase an annuity. So whatever's in the retirement component on retirement, he would then use to purchase an annuity. And of course, an annuity, as we know, is fully taxable, comes into gross income. And so, yeah, the annuity would become fully taxable as a normal annuity is taxed. Okay, so that's just a quick example to show you how this would work all the way through the various life stages until this person gets to retirement age. I just have a question I see in the chat box. Oh, power went off due to load shedding. Sorry about that. Hopefully you're all okay and still connected. I see it is 2:30 and I said that we would take a short break at 2:30. So let's take a 10-minute break. It's actually 2:31 to be precise. So let's take a 10-minute break and I will return at 2:41. Okay, I'll just pop it into the chat box and keep it there while I take a break, and I'll see you back at 2:41. Right. Okay. Hi, everyone. Hope that you are all well refreshed and that you had a good leg stretch, and we can carry on. Okay, so in the second part, we'll look at the new dispute rules and some of the SARS developments, and then also look at the new filing season rules. So the new dispute resolution rules, just to have a look at this on the link here, you'll see that these rules were published on the 10th of March. And these rules came into effect immediately. Now, these are the rules that are published when I talk about the new rules, the rules promulgated under Section 103 of the Tax Administration Act. So these prescribe the procedures that have to be followed when lodging an objection and appeal against an assessment. So these are the rules that go in and tell us exactly what has to happen, what the timeframes are, and how to go through the alternative dispute resolution and so on, the procedures of the tax board, the procedures of the tax court, and applications on notice and so on. And they obviously are quite extensive. Now, there was no pre-warning about these rules changing, and there doesn't seem to have been any sort of discussion with stakeholders that happened. Suddenly, these rules just appeared and they came into effect immediately. I guess the reason why they didn't feel it necessary to warn people that they were changing the rules is that it would seem that all of the changes that have happened have actually been changes that are to the advantage of the taxpayer, and that the taxpayer is not disadvantaged in any sense. And I just have to find my slides again. There we go. Okay, so the biggest change in these rules is that the deadline for lodging an objection, it's changed now from 30 days from the date of an assessment to 80 days, all right? So it's giving people longer, and that's why it would seem that it is to the benefit of taxpayers, and that's really the only deadline that has been extended. So all the other deadlines remain the same, but the deadline for lodging an objection has shifted out to 80 days, and it's always business days when you're talking tax administration. So just to bring that to your attention, that these are now the rules that do apply, and the old rules that were published in 2014 and that we've been using since that date have now been repealed. All right, so don't refer to those rules, don't use those rules anymore. Use these new rules that were published on the 10th of March, 2023. But as far as your other sort of processes are concerned, request for reasons, the entitlement for reasons, the due date for requesting reasons and all that sort of thing, and going on to appeal, going through the ADR, all of those dates and deadlines remain the same, except, as I say, for the deadline for lodging an objection. There are some other changes that have happened. For example, the chairman of the alternative dispute resolution process, it seems to be a broader spectrum of people that can actually oversee that process. So again, it would be to the advantage of the taxpayer, and there that the taxpayer and SARS can agree on who the chairperson of that hearing, that sort of arbitration hearing, is going to be. Yeah, and otherwise, some of the other changes seem to be more sort of cosmetic, playing around with wording, not specifically changing the impact of the rules and so on. Yeah, but just be aware that in terms of working with these rules, you need to now be working with this later version. All right, and following the changes to the dispute resolution system, SARS has made various enhancements to their processes, and these enhancements also ensure that only the tax in dispute is considered for suspension of payment. Now, remember, of course, that entering into a dispute does not automatically suspend the obligation to make payment of the amount that is due in terms of the assessment. And so it will be necessary to apply for a suspension of payment process. And there, of course, it's only the tax in dispute. So you might have a multiple, maybe you've got penalties and interest and an actual assessment, and perhaps you are only dealing with the one part of that assessment. So you're just dealing with the assessment, but you're not dealing with the penalties and interest, or you might just be dealing with penalties, or you might just be dealing with interest and not with the assessment itself. So it's only that part that you are disputing that is considered for suspension of payment, right? And then they've made some other changes on their system, calculating the disputed amount, the value the calculation will be automated, so that will reduce the time taken in internal allocations and looking at suspension of payment and so on. Updating taxpayer contacts. So every taxpayer, of course, has their contact details on the SARS system, but you would now be able to designate a specific contact for purposes of the tax dispute, all right, which might be different contact details to what you normally have in terms of your taxpayer profile. So this will facilitate earlier engagement with SARS and allow taxpayers to include the contact details of their representative, the person who's actually representing them in resolving the tax dispute. Request for remission, there does seem to be a bit of a problem with request for remission, but this functionality has been extended to include remission requests for provisional underestimate penalties levied under paragraph 20. So your underestimate, that 20% underestimate penalty levied under paragraph 20 of the fourth schedule. Looking at the request for remission, you could still use the RFR form to request remission of that penalty. Remember that that penalty can be remitted if the taxpayer is able to show that their estimate was based on information available at the time, was seriously considered, and was not intended to evade or avoid the payment of any tax, etc. All right, so there are possibilities where you can get those underestimate penalties remitted, and you use the request for remission form to do that. Requests for reasons, this is another area where people sometimes do have problems with SARS. Every taxpayer, and it's stipulated in those tax court rules that I showed you just now, the ones that we published on the 10th of March, the new version, that every taxpayer is entitled to request reasons for an assessment, and they must get reasons that will enable them to formulate their objection. SARS has now automated, they provided new automated request for reasons outcome letters. Previously, if SARS agreed that reasons had to be supplied, manual letters were issued, but now that's all been automated. As far as objections are concerned, where SARS requires additional substantiating documents to enable it to consider an objection, it is now able to issue up to 3 requests to the taxpayer, and that will ensure that the information gathering is done during the objection phase of a tax dispute. On appeals, there's again automated letters that SARS has put onto their system, and that is to confirm that an appeal is suitable for ADR, extending the period of the ADR proceedings, terminating the ADR proceedings, and confirming the outcome of an appeal. And then various internal processes have been streamlined to reduce the resolution times, especially appeals in ADR proceedings. There were some problems in terms of closing off these proceedings and then getting an assessment actually issued to reflect the outcome of the proceedings. And so they do say that those processes have now been streamlined to improve that. The enhancements in taxpayer contact details and automated notices will greatly improve communication. And this is all in line with the SARS Vision 2024 to improve their digital platforms and technology infrastructure. And they're hoping that this will improve the whole process. Well, it will be interesting to see what happens going forward, because certainly it has been an extremely problematic process in the past, and it's been made more problematic, I think, for tax practitioners, because SARS has typically not met their deadlines in terms of these rules. They have received a lot of criticism from the tax ombudsman, and I think a lot of these improvements in their processes is probably as a result of that, and hopefully we'll see that this whole dispute resolution process is more automated, more streamlined, and will function better going forward. Right, then let's turn to the topic of the day, which is 2023 filing season. So today's the 6th of July. And filing season kicks off on the 7th of July, although SARS has indicated only 8 o'clock tomorrow night. So if you've got nothing else to do on a Friday night, you can, of course, make use of that time to get some of your tax returns submitted. But in the meantime, SARS has, of course, been issuing auto assessments. That process seems to have started since last weekend. It's not always 100% clear who's been issued with auto assessments, but I see one of the things on SARS website, and you can pick it up on their social media accounts as well, is a link where you can put your information in to find out whether a person has actually been auto-assessed. Okay, so if you're not sure whether you've been auto-assessed or not, you can pop that into the SARS link on their website. I'll give you the link just now that'll take you to the filing season website, and all that information will be there. But of course, the question around filing season always comes back to who has to actually submit a return. And it also links to who has to register as a taxpayer. Now, we know that SARS recently, well, over the last few years, has required employers to register all their employees as taxpayers, so they will have tax numbers. That doesn't necessarily mean that they have to file a tax return. In fact, when you look at the Income Tax Act, Section 60 of the Income Tax Act says that a person who is required to submit a tax return is a person who is required to register as a taxpayer. So often people say, well, who exactly has to register as a taxpayer? And the person who has to register as a taxpayer is a person who has to submit a tax return. And so it comes back to this question, well, who actually, that's in Section 67, Section 67 of the Income Tax Act. So who has to submit a tax return? Well, that is determined every year by notice in the Government Gazette. And so for this year, it's Notice 3540 that was published in the Government Gazette on the 14th of June. And so the notice looks like this. There you see the notice coming through there, Notice 3540, and it's the Commissioner who's telling us that the persons specified in this notice are the ones who have to submit tax returns for the 2023 year of assessment. Okay, and if I scroll down here, I'm hoping that you can all see this, that the 2023 year of assessment in the case of a company means a year that ends during the 2023 calendar year. And for any other person, it's the year of assessment ending at the end of February 2023. Now, I just want to see a question from Graham here. SARS have always been able to issue revised assessments, but nowadays they're raising these by way of issuing a revised return. Surely only the taxpayer or authorized representative can file a return. Interesting. If so, surely the related assessment is invalid. That's a very interesting one, Graham. You're quite right that, I mean, SARS' role is to issue assessments based on the return, and only the taxpayer can submit a return. Yes. You know, even this question around SARS issuing auto assessments, which I'll come to a little bit later on, there's some question around the legality of auto assessments, you know, and how exactly do they fit into the tax law, because SARS is just raising an assessment based on the information that they have. They'll say that they're doing that on the basis of Section 95 of the Tax Administration Act. But Section 95 of the Tax Administration Act does not specifically speak to auto assessments. It's kind of, auto assessments is a creature of SARS. It's something that has been designed and developed and invented by SARS. And it doesn't really fit clearly within the TAA. So this is, yeah, the ability of SARS to issue revised returns is not something that is catered for in the Tax Administration Act. And it's a bit of a strange practice, that. And I'm not sure, without seeing an actual example of how it's actually happened, and I'm not suggesting that you must provide that to me now, but I can't really speak too specifically to that process, except to say that it's not catered for. What happens is that SARS calls for returns, taxpayers submit returns. SARS' role is to then assess taxpayers based on the returns that have been submitted. Now, I just want to take you through the structure of this notice, because I've found in years gone by, I talk about paragraph 3, and then people are saying, where do you find that paragraph? So I just want to show you that in this notice that's published in the Government Gazette, so we have this general aspect, right, with these definitions. Then in part 2, paragraph 2, it tells us who. Yes. If you
open up a link, it's not showing, by the way.
Oh dear. Okay, I'll have to just use my slides then. Thanks for telling me that.
Just letting you know.
Okay, shame. All right. Well, never mind. The link is there on your slides, and if you click on it, you'll be able to open it and see the notice. But just to highlight, the notice consists of that part 1, which is general, part 2 that gives us the rules around who must submit a return. Part 3 then has an exclusion, people who don't have to submit a return. And then part 4 has the deadlines by which the returns have to be submitted. So if we go through to actually look, and I mentioned about the registration requirement, if somebody's required to submit a return, they have to register, they must register within the 21 business days. That's in terms of the TAA. If we look at this notice in the Gazette, and this is what I was saying in terms of the 2023 year of assessment, and there I've just copied what the Gazette actually tells us. And then we go into who has to submit a return. So this in terms of part 2 of the notice, and it lists all different people. If we start with resident companies and other juristic persons. Now, I have found that many people have become somewhat confused with the requirement, especially of a company, to submit a tax return. People will say, but my company is dormant, so why do I have to submit a tax return? Well, if you've got a resident company, you look at the requirements of which companies have to submit tax returns for the 2023 year of assessment. You'll see if it has gross income of more than 1,000 Rand, assets or liabilities of more than 1,000 Rand at any time during the 2023 year of assessment. All right, so that speaks for itself. Any capital gain or loss of more than 1,000. So the actual capital gain or loss before working out the percentage inclusion in taxable income and so on, the actual capital gain or loss in that year of more than 1,000 Rand. But then, and this is what brings in virtually every company into the requirement to submit a tax return, is any resident company that has taxable income, taxable turnover, but have a look at this, any assessed loss. So if you've got an assessed loss or an assessed capital loss from the previous year, even though you might have no taxable income for the current year, that still requires this company to submit a tax return. Okay, so it really looks then, you know, there's not many companies that would be exempt from submitting a tax return, because based on this, they're either going to have assets, liabilities, gross income, or an assessed loss or an assessed capital loss. And on that basis, they would have to submit an ITR 14 for the 2023 year of assessment. For non-resident companies, obviously non-residents are only taxed in South Africa on SA source income, and that includes if you've got a permanent establishment in South Africa. So if you've got a non-resident company that carries on a trade through a permanent establishment in the Republic, or they've derived any income from a source in the Republic, or they've derived any capital gain or loss from the disposal of an asset to which the 8th schedule applies. Now, as far as a non-resident is concerned, the 8th schedule only applies to immovable property in South Africa or assets effectively connected to a permanent establishment in South Africa. All right, so a non-resident selling those assets would have to work out a capital gain or loss and apply the rules of the 8th schedule to the disposal of that asset. A non-resident with immovable property outside South Africa, not connected to a permanent establishment in South Africa, that is not taxed in South Africa. So they wouldn't have to submit a tax return if that was the only capital gain that they had. All right, but if they have any capital gain from the disposal of an asset that falls within the scope of the 8th schedule, or they carry on trade, or they derive income from an SA source, they have to submit a tax return. But then look at this next one as well. So you might have a non-resident company. Now, whether a person is resident or non-resident, of course, that goes back to the Section 1 definition of resident in the Income Tax Act. And when you look at that Section 1 definition of resident, as far as a company is concerned, it talks about two possibilities. It talks about a company that was incorporated or formed in the Republic or effectively managed in the Republic. All right, that would make it a resident. However, the whole definition of resident, whether you're talking about individuals or companies, it excludes any person that's deemed to be exclusively a resident of another country in terms of a DTA between South Africa and that other country. So if we have a company incorporated in South Africa, at first glance, it would come into the definition of being a resident, except if that company is now deemed to be exclusively a resident of another country because of the application of a DTA. And that would be typically where the company has shifted its effective management to the other country. and then the company is deemed to be exclusively a resident of the other country, then it's not a resident of South Africa. However, notice here that if it was incorporated in South Africa and it's not a resident because of the application of a DTA, it's still required. Any non-resident company is then still required to submit a tax return. So be careful of this, because obviously if you're required to submit a tax return and you don't submit a tax return, then you end up with that penalty for failing to submit. Yeah, Peter, you say that they want tax returns even from those who have none of the above. Yeah, although legally they can't require, because the legal requirement to submit a tax return is the people who are listed on this notice. But this notice is extremely broad. The application is extremely broad. If we look at trusts, any trust that was a resident during the 23 year of assessment must submit a tax return. We see there that SARS is really clamping down on trusts, and they are requiring trusts to submit tax returns. A non-resident trust, similar to a non-resident company, only if it's carrying on a trade through a permanent establishment, or it has income from a source in South Africa, or it has a capital gain or loss from the disposal of an asset to which the 8th schedule applies, then it would have to submit a tax return. Now, just another point on trusts, and getting back to that issue around third-party reporting, in the draft notice that I spoke about earlier, remember I said that the electrical contractors had now been taken off the requirement to submit the third-party reporting. Now, trusts were also included in the draft notice, and indeed are also included in the final notice for submitting, for providing the third-party reporting. And in the draft notice, it stated that trusts had, or trustees had to submit these reports by the end of September. Some of you might remember that specific deadline date. Now, in the final notice that has now been published, they no longer make reference, and I just want to get this final notice, I just want to get the actual wording in front of me so that I can just get it 100% clear in terms of what it says. Sorry, excuse me a sec, I just pressed the wrong, get my... So it's under, if you go to SARS Legal Counsel under secondary legislation, and it's under public notices there, you will see there that they've had this public notice that was published on the 30th of June. And this is now the final published notice that has been gazetted, which talks about third-party reporting in terms of Section 26 of the Tax Administration Act. And as far as trusts are concerned, so it says the following persons are required to submit a return. And in 2.15, it says a trust, all right, a trust as defined that is a resident or a non-resident that is required to submit an income tax return. Those kind of trusts, in other words, the same trusts as we're referring to over here, have to submit this third-party report. However, what they've done on this final notice, and this has only just become knowledge, so that's why I didn't have it on my slides, is that they have put the due date of this notice, the third-party report, they've now said it must be submitted for the period 1 March to the end of February. It must be submitted by the 31st of May each year. Now, of course, the 31st of May has already passed, and this notice was only published in the Government Gazette on the 30th of June. So it would seem clear that this third-party reporting requirement is not required for the 2023 year of assessment, but it will become required for 2024 onwards. And so for the year ended February 2024, a trust would have to submit this third-party report. SARS will have to provide the format of that report, etc. And the trustee would have to submit that report for the February year end by the end of May, which seems extremely tight. And I know people are already saying that's impossible because they won't have all of the reporting from the banks and so on in time. But nonetheless, that is what is now in this final gazetted requirement. So SARS is going to have to do something about that particular date, I think. But at the moment, it's sitting at May, but it'll only affect trusts for the 2024 year of assessment. Okay. But for now, trusts do have to submit their tax returns for the 2023 year of assessment. What is the Gazette name with the trusts? With this third-party report, the Gazette name, maybe I should just at the end of the webinar, I should perhaps just share the link, but it is Gazette number it's notice number 3631, and it's in the Government Gazette dated the 30th of June. Okay, 30th of June, 2023. Okay, and if you go onto the SARS website, as I say, if you go to the SARS website and you have a look under legal counsel, and then go to secondary legislation, and then go to public notices, it's the most recent public notice that has been published. All right. But I will send a link through to Danny at the end of the webinar. Yeah, and then Danny can perhaps just share it with all of the delegates. That's for the third-party reporting. It's been a concern to me as to why they were taking so long to finalize that notice, but obviously there was a lot going on behind the scenes. Okay, back to who has to submit tax returns. Now, if we go to individuals, so we've done companies, we've done trusts, what about individuals? Now, I know we'll get onto the exclusions just now around auto assessments and around people who only earn remuneration and so on. But to start with, in part 2, they say, right, who does have to submit? Okay, this is subject to the exclusion under paragraph 3, which we'll come to. But initially, the people have to submit anyone who carried on a trade other than solely as an employee. Now, interestingly, if you carry on a trade, then you've also got to think about the fact that you are a provisional taxpayer, all right? Because when you look at the rules around submission of the tax return, of course, just now we're going to get onto the due date for tax returns, and we know that provisional taxpayers have a different due date to other taxpayers, as long as the provisional taxpayer is submitting through e-filing. But when we talk about who is a provisional taxpayer, basically an individual who's carrying on a trade would be a provisional taxpayer, all right? And would have to also, if you're carrying on a trade other than solely as an employee, because employment is a trade, okay, but that's subject to remuneration, which is subject to employees tax, so that won't make you a provisional taxpayer, and there's, you know, we'll come to the issues around the exclusions for the normal tax return just now as well. Okay, but if you carry on a trade, you have to submit a tax return. If you have capital gains or losses exceeding 40,000 Rand, you have to submit a tax return. If you had any funds in foreign currency or owned any assets outside the Republic, if the total value exceeded 250,000 at any time during the 2023 year of assessment. So even if it's fallen down below that by the last day of the year of assessment, if it went above that at any time during the year, you would have to submit a tax return. If you had any income or capital gains from funds in foreign currency or assets that are attributed, so that's talking about, that would be where you are a donor and you've donated money, and that can include a low interest loan, right? Because that also creates the impact of the deeming provisions of section 7 or the attribution rules of paragraph 68 to 72 of the 8th schedule. So if you're the donor or the lender here, and there's funds that are attributed to you, and it's from funds in foreign currency or assets outside the Republic, and you've now got the attribution rules, or you've got section 7 that applies to you, then you have to submit a tax return. If you had any participation rights in a controlled foreign company, you have to submit a tax return. If you have any taxable turnover, now if you have taxable turnover, that means that you are a micro business and you have to submit the turnover tax return. And that's a different animal to the income tax return, but it's covered by the same notice. And that's why they refer to this over here. And then have a look at this. If you are a resident individual, and if you have gross income in excess of the tax threshold. So it gets a little confusing here because this is the tax threshold. The tax threshold is your taxable income. When you have taxable income above this amount, then you end up paying tax. Below this amount, you don't pay tax. So this talks about somebody under 65, all right, over 65, but under 75, and then over 75. Okay, so, but now it says if you have gross income, so it's not just a case of if you have income above the tax threshold. All right, so you might have gross income. Gross income includes dividends, and dividends are generally tax-free under section 10(1)(k). So you might earn 100,000 Rand of dividends every year, but your taxable income is 0 because it's all exempt. But you had gross income in excess of the tax threshold. okay? And so there, that initially that would say you have to submit a tax return. Now I'm coming to the exclusion under paragraph 3, but initially it would bring you into the scope of having to submit a tax return. If you had interest income, let's say you were over the age of 65, so your interest exemption is 34,500. Maybe you have interest income of 100,000 a year, of which 34,500 is exempt. And so you're definitely below the tax threshold. You're not going to have to pay any tax, but your gross income exceeds this designated amount, which means you do have to submit a tax return. So just be very careful about this. This is how poor old retired people who don't know any better end up with penalties for non-submission of tax returns, because they figure, well, I don't have to pay tax, so why do I have to submit a tax return? But it can be because of this rule over here, just because you have gross income in excess of these designated amounts, which happen to be the amounts of the tax thresholds. All right. That's for resident individuals. Again, non-residents, you've got to see this through the lens that non-residents only pay tax in South Africa on SA source income, or if they're carrying on a trade in the Republic. So if they carry on a trade, obviously they'd have to submit a tax return. Capital gains or losses from an asset subject to the 8th schedule. Again, gross income in excess of the tax threshold, but gross income here, in terms of a non-resident, by definition, its gross income is only where that income is from a South African source. Okay, so if it was non-SA source income and it's a non-resident, it wouldn't come into gross income anyway. Then the other one is if they have gross income that included SA source interest that is not exempt under 10(1)(h). Now 10(1)(h) is a blanket interest exemption for non-residents, all right? So SA source interest going to a non-resident, if they qualify for 10(1)(h), fully exempt. But they don't get this exemption if they spent more than 183 days in South Africa in the 12 months before that interest became owing to them or became due and payable. So if they were non-resident, but they spent more than 183 days during this 12-month period, so they didn't get the 10(1)(h) exemption, they're getting SA source interest, they would then go down to the normal exemption that the rest of us get, the 23,800 or the 35,500. But the point of the matter is, if they have gross income that included SA source interest that's not exempt under 10(1)(h), they have to submit a tax return. And it doesn't say how much gross income at this stage, although we'll get to the exclusions just now. Okay, but initially, these are the people that come into the sort of under the umbrella of they have to submit tax returns. But then, of course, you look at the exclusions under paragraph 3, and I'll come back to that deceased estate just now. The paragraph 3 exclusion says that individuals or deceased estates, if your gross income consisted solely of one or more of the following, all right? So we're saying you've got gross income above the tax threshold, but if that consisted only of one of these amounts here, nothing outside of this, then you would not have to submit a tax return. So if it was remuneration from a single employer, not exceeding 500,000 and the correct amount of employees' tax has been withheld, all right? There are some exceptions there, and that would be if you got allowances, all right, other than a purely reimbursive allowance or your reimbursive travel allowance, or you had a company car. If you have a company car, you have to submit a tax return. If you get a travel allowance, other than a purely reimbursive travel allowance, you have to submit a tax return. And notice here, even if you only work for one employer and the correct amount of employees' tax was withheld, or maybe there was no employees' tax to be withheld, but if you accrued any amount in respect of services rendered outside, any amount in respect of services rendered outside the Republic, okay, then you have to submit a tax return. And I think a lot of people overlook that part. They say, well, I'm paying tax on that money anyway, or maybe it was exempt under section 10(1)(02). But the point of the matter, whether it's taxable or whether it's exempt, it makes no difference. You are obligated to submit a tax return if you earn any remuneration from services rendered outside the Republic. Okay, going back to people who don't have to submit tax returns. So if your gross income consisted of SA source interest, which was below the normal exemption, 23,800 or 34,500. Or if your gross income consisted of dividends, if you were a non-resident throughout. So going back to my example just now, that someone who got 100,000 Rand local dividends and they're a resident, those local dividends are exempt, but there's nothing here that qualifies that person to be exempt from submitting a tax return, except that, well, yeah, because I mean, there's nothing here that talks about somebody who only gets dividends as a resident. This talks about dividends received by a non-resident during the 2023 year of assessment, or any amount from a tax-free investment. So if you were getting money from a tax-free investment or a single lump sum from a retirement fund. So if you've got gross income from rental income, in addition to remuneration, dividends, and interest, yes, you would have to submit a tax return because you've got gross income that's coming outside of just what is designated in these 5 things over here. But if your gross income, which might be 3 million Rand a year, but if that was derived, one from remuneration from a single source, a small amount of interest, 20,000 Rand's interest that was all exempt, and some income from tax-free investments, then you would not have to submit a tax return. Okay, so yeah, you have to work through who has to submit in terms of paragraph 2, and then who does not have to submit in terms of paragraph 3, bearing in mind that when you're earning remuneration, although you might get remuneration from a single employer and it's being correctly taxed, but if it's in the form of an allowance, etc., you would still have to submit a tax return. Now, to go back to deceased estates, if they have any gross income. Now, this is interesting. It doesn't say anything about capital gains. What if you had no gross income, but you had a taxable capital gain in the deceased estate? Taxable capital gain comes through section 26A. It's added into the taxable income calculation right at the end. It does not come into gross income. So it's quite conceivable you might have some deceased estates that have no gross income, but they have a taxable capital gain. And here it's saying only if they have gross income do they have to submit a tax return, which doesn't seem to reflect the practical requirement there. So I think that is a bit of a problem. And then anybody who is required to submit a tax return, so that goes back to the point Peter was making earlier, if they want a tax return from you and they require a tax return from you, then in terms of this notice, you would have to submit that tax return. Okay, now I'm going to come to auto assessments just now, but let me just see what question Ian has asked. Usually Ian's questions are too complicated to address in a few minutes, but let's have a look at this one. In terms of the SARS 2023 tax timetable and those individuals required to submit returns, is a customer foreign currency, a CFC account of the local bank, regarded as a foreign asset? And what about an investment in a foreign company listed on the JSE? Well, that's not a foreign asset. I can tell you that with a foreign company, a dual listed company, that's not necessarily a foreign asset. Or an investment in a local ETF or local unit trust holding shares in foreign entities. So again, Ian, this does get complicated. But in terms of the customer, the CFC account with a local bank, I guess whether it's a foreign asset or not would link to whether you had to get exchange control approval or get the SARS TIA approval to actually make that investment. Did you have to use any of your offshore allowance in order to make that investment? Might be some indicator as to whether that's a foreign asset or not. I would suggest that if you're not sure and it looks like it could possibly be a foreign asset, then you should rather err on the more conservative side and rather submit, as opposed to just assuming you don't have to submit and then ending up with non-submission penalties. So I think, yeah, but certainly if you invest in a dual listed company, a foreign company that's listed on the JSE, I can't see that that would be a foreign asset. But it's an interesting one because as far as I know, and let me just check this in section 1, as far as I know, foreign asset, that concept of foreign asset itself is not something that is actually defined. Let me just confirm that. No, foreign asset itself is not something that is defined. So it would indicate that it would be an asset that is situated outside the Republic, like a foreign company is a company that's not a resident, but a foreign asset situated outside the Republic Yeah, I think it probably links to the question of whether you had to use your foreign investment allowances or get exchange control approval or get a tax compliance approval in order to invest in that asset. But if in doubt, rather just submit the tax return. If that's the only thing standing between whether to submit a tax return or not, then I would suggest rather just submit. But let's just have a quick look at this auto-assessment process now. And of course, we've had the auto-assessment process. This is now the third year. First year was a little bit of a guinea pig experiment. Second year went a little bit more smoothly, I think, but there's still problems with the auto-assessment process. And now this year, it seems that it's kind of following the process of last year, but they've made one important change to streamline things. Now, first of all, paragraph 3, which talks about the exclusion, people who do not have to submit a tax return. And that would be an individual who's notified by SARS that they have been auto-assessed. Well, I'm not sure that you always get notified, but you should get notified if you're eligible for auto-assessment. Of course, if that happens, you must have a look at how SARS has assessed you and check that everything is 100% correct. Now, I've seen tax practitioners saying, well, their clients don't want to mess with an auto-assessment. They don't want to rock the boat. And so even if SARS auto-assessment is not 100% correct, they still want to just leave it. Well, the thing is, you can't, because the law says that what SARS is, they're basically offering you a suggestion at an assessment, and they're saying, is this correct? Now, I do think it was better the year prior to last when you had to accept that auto-assessment. I know it might have created a few administrative problems for some people in terms of, they didn't accept it, and then it was a delay with getting the refund, but surely it must be a better option for the taxpayer to actually accept it. But they don't have that option on the system. They simply put out the auto-assessment, and then if there's a refund, they pay the refund within 72 hours. If you're not happy with what's on the auto-assessment, you've got until the 23rd of October. So that's the due date that's applicable to non-provisional taxpayers. You've got up until that date to submit an accurate return. And this is when things start getting quite complicated, because now in the meantime, SARS has done an auto-assessment. They've refunded you your tax. You realize that, hold on a minute, I've got, some other income that should be declared there. I've got maybe some rental income. Or maybe I've got additional medical expenses that SARS hasn't taken into account because they're amounts that are paid directly to providers. They didn't go through the medical aid. And so there's other things that need to be taken into account. Now, if you're not happy, and then go ahead and submit your tax return with all the correct information, that then generates an assessment. And perhaps either you get a refund or you have to pay in. But what about this refund that SARS has already paid? It seems that in some cases it becomes problematic to get this refund reversed. Of course, it has to be reversed because you effectively have to pay it back. Well, it depends what your final assessment looks like in relation to the auto assessment. But it does get a little bit problematic because in the meantime, SARS has paid the refund. And if it turns out that that refund has to be paid back to SARS, then of course the taxpayer must be able to pay it back. So they mustn't go off and spend it. Okay, so it is incumbent on taxpayers to check the auto assessment. And if it's not correct, then they've got until the 23rd of October to file an accurate return. So in terms of the auto assessment process on the SARS website, they say that this is how it's going to work. Taxpayers will be notified by SMS or email if they were selected to receive an auto assessment. SARS also has this platform available, as I say, on their website. Go to the filing season website on the SARS page, and you'll see there that there's a link. You can click in there and put all your information, and it'll tell you whether you have been selected for auto assessment. If you receive the SMS, then you must review your auto assessment. And if you agree with it, you don't have to do anything. If you're going to get a refund, you just sit back and wait for that refund to come into your bank account, which should happen within about 72 hours, they say. If you owe SARS, then you must pay by the due date shown on the assessment. If you don't agree with the auto assessment, you submit a proper tax return by the 23rd of October. All right, so that's basically how the auto assessment process works. There's nothing requiring you to actually accept the auto assessment or confirm with SARS that the auto assessment is correct. They assume it is correct unless you go in and submit a return. Now, just an interesting aspect, I mentioned earlier that there's no specific legal box or legal provision in the Tax Administration Act that deals with these auto assessments. Section 95, SARS will say that it really comes into Section 95. Section 95 talks about estimated assessments, and it says SARS can raise an estimated assessment if the taxpayer does not submit a return. That's normally anticipating where you fail to submit a return, and they can go and then raise an estimated assessment. And as you know, they often do that. But they are riding within Section 95 and saying, well, we're saying you haven't submitted a return, so we're going to raise an assessment. Now, in terms of this process of Section 95, SARS raises the assessment, and I'm kind of blending now the auto assessment process with what is in Section 95. But it then says, of course, in Section 95, it still talks about the fact that you've got 40 business days to submit an accurate return. But SARS is not using the 40 business days this year. They've given automatic extension through to the 23rd of October. So it's the same submission date as applies to all of your other non-provisional taxpayers. The idea is that if you're auto-assessed, you shouldn't really be a provisional taxpayer. Now, again, practically that's not always a clear split. Sometimes you do get provisional taxpayers, but you shouldn't really be in the auto-assessment process. But it might be that just, initially SARS, for some reason, puts you into that process when you shouldn't really be there. So here you're saying, well, provisional taxpayers have until January 2024. Now you're saying I have to submit by the 23rd of October. And yeah, unfortunately, if you're in the auto assessment process, that is the date that you're going to have to look at, unless you manage to get SARS to give you an extension, which is going to become a bit of a mission. But it does say in Section 95 that if reasonable grounds for an extension are submitted, a taxpayer may extend. But it says it may extend the period referred to in subsection 6, which is that 40 business days. So SARS has really basically granted the extension through until the end of October, or 23rd of October, 2023. All right, so if you want any other extension, you're going to have to do that on a case-by-case basis. If you get auto-assessed and then you realize that there's other information that SARS requires, so you then submit a proper tax return and you get assessed. And if you're not happy with that assessment that SARS raises, you have to also realize that you're out of the normal assessment process. Once you've gone into the auto assessment process, which you never chose at the beginning, SARS put you there, you're actually in a different boat to other taxpayers. So if you come out with an assessment once you've submitted your tax information and you're not happy with the assessment, you can't just go the objection and appeal process. You actually have to then apply for a reduced assessment using Section 93, and then only thereafter would you be able to go the normal objection process. So yeah, it can become quite a convoluted and complex process, and it probably goes a bit beyond what we have time to talk about today. But I just wanted to warn you about that it is a slightly different process to what you deal with as a normal taxpayer. In the SARS guide to the tax return for individuals, the ITR 12, they say if you agree with the auto assessment, but later identify other things that you need to declare to SARS, then you refer to the following sections on the ITR guide, disagreeing with an auto assessment and requesting an extension. Now, I think I have put that on here. Yeah, so we'll come to that just now. After the filing season due date for non-provisional taxpayers, that's 23rd of October 23, the original assessment based on estimate will become final. In other words, if SARS has auto-assessed you and you haven't gone in and said, hold on, I need to submit a proper tax return, and actually submitted that return by the 23rd of October, well, their assessment becomes final on the 23rd of October. All right. And then it becomes only possible to ask to then go through a rather complicated and convoluted process of getting a reduced assessment. If they have an original assessment based on an estimate, that's using the wording of Section 95 of the Tax Administration Act, it says it's only subject to objection or appeal if SARS decides not to make a reduced assessment after the taxpayer submits the relevant material within the time stipulated. So this is basically putting in formal language what I was explaining just now, that if you're auto-assessed, you then submit your tax return, SARS then assesses you based on what you've submitted, and you're not happy with the assessment, you have to first apply through Section 93 for a reduced assessment. And then if they say, no, we're not going to make a reduced assessment, then you can go on to objection and appeal. It just becomes a more convoluted process. In their guide, and this is linking to what they said over here, disagreeing with an auto assessment. In the guide, they say that you must file by the 23rd of October. If you disagree with the pre-populated data, you must, in other words, with the third-party data that's been submitted, the employer or the bank, you got to go back to the source and you got to get that fixed. You can't get SARS to fix what's on a third-party report. All right, once that's corrected, then you can edit and file your return. If there's any financial changes on the edited return, then SARS will have a look at that. They may request supporting documents, etc. Okay, and then they'll go ahead and assess you. If they decline to reassess your return, you'll receive a rejection letter. If you're dissatisfied with SARS' decision, you may lodge an objection within 30 business days from the date of the rejection letter. This is if you want to apply for a reduced assessment and they say, no, we're not going to give you a reduced assessment, then you've got 30 business days. And notice here, they say 30 business days to lodge an objection, and this is in their guide. Okay, for the request for the extension, so we said you got to submit by the 23rd of October unless you get an extension. If you don't agree with the auto assessment and you're unable to file by the due date, 23rd of October, you can provide reasonable grounds and ask for an extension. And as I say, that would really be on a case-by-case basis as to whether you're going to get that extension granted or not. Now, just to reiterate, I've mentioned these dates a little bit already, but companies have to file 12 months after the end of their financial year. Others, non-provisionals, 23rd of October, provisionals who are submitting through e-filing, and this is people other than companies, right? So trusts or individuals who are provisional taxpayers, they have until the 24th of January, 2024. This comes back to the question of whether this person is a provisional taxpayer or not. And I have gone into this in quite a bit of detail in some previous discussions that we've had. But remember that the definition of provisional taxpayer is in paragraph 1 of the 4th schedule. And whether a person is a provisional taxpayer or not has to be determined on a year-by-year basis. In fact, SARS determines when they actually assess that taxpayer at the end of the year. That's when they decide whether, in fact, this person was a provisional taxpayer for the year or not. So it's quite conceivable that a person may be a provisional taxpayer, maybe they were a provisional taxpayer in 2022, but they might not be a provisional taxpayer in 2023. Okay, because if you look at the exclusions from being a provisional taxpayer, for example, if the person's investment income didn't exceed 30,000 Rand for the year, and they had nothing else that made them a provisional taxpayer, then they would not be a provisional taxpayer for that particular year. Then they would be expected to submit by the 23rd of October. So if you're dealing with a lot of individuals and trusts, okay, don't assume that all trusts are provisional taxpayers. Again, with trusts, you need to look at the definition of provisional taxpayer and assess whether those trusts are provisional taxpayers or not. All right. If a trust is not a provisional taxpayer, it would have to submit by the 23rd of October. If it is a provisional taxpayer, it must submit by the 24th of January next year. All right, so you need to think carefully in terms of your clients to assess whether they will be provisional taxpayers for 2023 or not. And just because they're provisional taxpayers for last year does not mean that they're a provisional taxpayer this year. Just because they submitted RP6 forms does not make them a provisional taxpayer. It'll be a case of saying by the end of the year, have a look at where they got the income from, what was their level of investment income, etc. Would they be a provisional taxpayer in terms of the definition in paragraph 1? Okay, so it does become quite a complex situation. And of course, it becomes very important in determining what is the due date for submission of the tax return. So just be careful. Don't let anybody go beyond the 23rd of October unless you are 100% sure that the person is a provisional taxpayer, in which case you can say, right, I can let them go until the 24th of January 24. Nice and easy to remember these dates, 23-10-23 or 24-1-24. Okay, so easy to remember them. Okay, what about the statements of assets and liabilities? So again, in their guide, they say that provisional taxpayers with business interests are required to declare assets and liabilities based on cost, and a new requirement, and this was stated in the budget speech, and it's now stated in their guide to this year's tax return. Taxpayers who are required to submit the statement of assets and liabilities that have assets above 50 million rand are required to declare specified assets at market values on their 2023 tax returns. Okay, so just be careful of that. Okay, with assets above 50 million rand, you need both cost and market value. Okay. Right, another aspect is foreign income disclosure. Now, when you talk about residents, of course, residents are taxed on a worldwide basis. I'm talking about individuals now, right? So on the ITR 12 for individuals, they have changed their container for foreign income because when you've got taxpayers who have to declare income from a foreign employer while working in South Africa, and if they do not have an appropriate source code to declare remuneration for foreign service rendered income. Now, they have said in the budget speech that going forward, and this is probably from next March onwards, any person employing somebody who's working in South Africa will have to register as an employer and will have to then comply with the requirements that apply to employers. But currently, it is possible to have a foreign employer, you working in South Africa, you're not paying employees tax, you would then be a provisional taxpayer, all right? But because your foreign employer is not a registered employer, they're not issuing RP5, so they don't have an appropriate source code for that income. Now, when you've got foreign income, you've got three new fields: foreign income disclosure. So if you've got a foreign employer and you're working in South Africa and abroad, or just abroad for a foreign employer, but you are a South African resident, okay, they've got these three new fields that are coming in. Income received from foreign employment services not reflected on an SARP5 or IT3, subject to tax outside South Africa, and the 10102 exemption does not apply. This 10102 exemption is that 183 days, you know, were you outside South Africa for more than 183 days, of which more than 60 days was continuous, but we're saying that exemption does not apply, all right? But the income is subject to tax outside South Africa. Now, the question is, okay, is it also subject to tax inside South Africa? Probably not in terms of a double tax agreement, but you'd have to disclose this in a separate field. Then these other two talk about the section 10101 exemption. That's people who are working as crew members on ships and aircraft. The first one talks about foreign employment services not reflected on an SA RP5 or IT3A, subject to tax outside South Africa, and this specific 10101 exemption does apply, and the other one talks about where it does not apply. Okay, so maybe it's exempt, maybe it's not exempt, that you would have to show it under the specific field. So just be careful. Anybody who's got foreign income, and I'm sure a lot of you probably even got friends and family, you've got to try and now do their tax returns for them. They're working outside South Africa, they're still residents, they've got to submit tax returns. Make sure that you disclose their foreign income in the correct field, all right? And maybe it's exempt, maybe it's not exempt, but then of course you've also got the DTA to think about. Maybe it's only taxed in the foreign country and it's not taxed here, but you've still got to declare that foreign income and make sure you declare it in the correct field. The other complexity is spouses married in community of property. Was not really a complexity, but some of the income is obviously shared between the spouses. They're taxed on half of the interest, dividends, rental income, and capital gains. And SARS has retrieved information. They've checked with the Department of Home Affairs, and they will be splitting this income between the taxpayers, and where they match it up and they say, right, these two are married in community of property, they will spread the income between the respective spouses. Okay, so that each one will only be taxed on 50% on assessment. Okay, in terms of reduced assessments, remember I've said earlier that if you apply for a reduced assessment, they have automated the process of requesting a reduced assessment under Section 93. You use this form called the RRA01. So if you get auto-assessed, you submit all your documents, SARS doesn't have all the information, you provide additional information by submitting your documents, you then get assessed. You're not happy with the assessment, you need to use this RRA01 to request a reduced assessment. If SARS gives you the reduced assessment, happy days. If they don't give you the reduced assessment, then you go on to the objection process. So yeah, it's a bit convoluted, but that's how it works. In terms of estimated assessment, they've got information here in terms of Section 95, when SARS raises an estimated assessment of what the process is, but this still talks about the 40 business days, whereas remember that for the auto assessments, which is, according to SARS, a form of an estimated assessment, it's not the 40 business days that you're looking at. You've got until the 23rd of October to provide the necessary information for SARS to raise an accurate assessment on the taxpayer. I hope all these links come through on your slides, because this is from the SARS website. You'll see the filing season 2023 website. So have a look at that. And then all these different guides that you need. If you're filling in company tax returns, make sure you look at their guide. If you're doing individuals, trusts, make sure you look at these guides, carefully look at them, because there are things that change from year to year. I've given you some examples like your foreign income and so on. Just make sure that you do disclose things properly on the tax return. Otherwise, it can lead to a lot of problems later on. There's also the new guide for provisional tax for the 2024 year of assessment. Obviously, we're just about to get to the first provisional return at the end of August for the 2024 year of assessment. And so it'd be important just to make sure you understand exactly who is a provisional taxpayer, who is not a provisional taxpayer, and how to do those calculations for the provisional returns. Okay, so lots of links to keep you occupied there and give you lots of information. And also, of course, you can also put that information out to your clients so that they can also get themselves properly set up for filing season. Okay, and then the last part of the presentation, and I'm just going to go through these court cases quite quickly because we're already at 3:45, and I promised not to keep you past 4 o'clock. If any of you have questions, you can pop them into the Q&A, and it'll just give me a few minutes at the end just to pick up on any questions that there might be. Now, this constitutional court case, Arena Holdings and others versus SARS and another, this was a really important case. Sorry, I'm losing my voice. This was an important case that came through the Constitutional Court, and it deals with taxpayer confidentiality. Oh, sorry, I've really got a tickle in my throat here. See if I can take a Strepsil while I'm talking, and hopefully that will clear it. I think we're all dealing with sinus issues and so on at the moment. Okay, sorry about that. Just give me a moment to get my my voice back, and then I will carry on talking. Otherwise, as soon as I talk, the throat closes up, and then back to square one. Okay, but this case, Arena Holdings is a company that owns financial media like the Business Day, Sunday Times, and so on. And this company and others includes a journalist in this particular case, they had gone to the Constitutional Court actually to confirm a finding of the High Court. And that was a finding of the High Court that had been handed down sort of end of 2021. And the High Court had found that certain provisions were unconstitutional. And so these taxpayers were then taking this matter for confirmation to the Constitutional Court. Okay, so Let me just get the link here. So first of all, they were looking at the constitutionality of Section 35 and 46 of the Promotion of Access to Information Act, and then Section 67 and 69 of the Tax Administration Act. Now, the Promotion for Access to Information Act obviously enables information to be accessed by certain people. But in Section 35, it has a blanket prohibition on accessing information kept by SARS, basically on taxpayer records. In that same part of the Promotion of Access to Information Act, it goes all the way through to Section 46. And Section 46 provides an exemption. So what it does in that part, Section 35, all the way through to Section 45, it lists certain entities where you cannot access records, right? And one of them is SARS with taxpayer records. But then Section 46 gives an exemption and says that in some of these cases, you can access in certain situations. And that's really, as it shows down here, where the disclosure of the record would reveal evidence of substantial contravention of or failure to comply with the law, or an imminent and serious public safety or environmental risk, and the public interest in the disclosure of the record clearly outweighs the harm. So it's what we call the public interest override. That's found in Section 46. But interestingly, Section 46 does not enable the public interest override to Section 35. Okay, so it applies to other sections, Section 36, 7, 8, 9, 40, 41, etc., but it doesn't cover Section 35. So what is it saying? It's saying that the Promotion of Access to Information Act enables access to certain records, but it completely prohibits access to people's taxpayers' records. And even though we have the Section 46 override, that doesn't apply to Section 35. So it basically means there's a blanket exclusion. You can't access taxpayer records. And of course, if you look at the Tax Administration Act, Section 67 and 69, we know the confidentiality provisions. We've got a prohibition on disclosure, and we've got the secrecy provisions of Section 69. Now, what these appellants were arguing is that these provisions were unconstitutional because there should be circumstances where taxpayer records can be accessed. Now, it's interesting, the background of this came about that book by Jacques Poe. He wrote it, I think it was probably about 5 years ago now, All the President's Keepers. And it was a book about Zuma and the fact that he alleged that Zuma had not submitted tax returns and had not declared information, and yet his tax records were not open to journalists or to any kind of scrutiny because the commissioner had argued that, you know, they were covered by the secrecy provisions. And so the journalists, basically Arena Holdings and the journalist himself, were arguing that there should be some exceptional circumstances where taxpayer records actually should be revealed. And it would be in terms of this public interest override where you've got there's evidence of substantial contravention of or failure to comply with the law, or imminent and serious public safety or environmental risk, and the public interest outweighs the harm. So yes, you're looking at a balance here between privacy, the right to privacy, and the right of the public to know when you've got very high level leaders and so on in the country that are not complying with the law. Okay, so to cut a very long story short, it was found by the High Court and confirmed by the Constitutional Court that these provisions were in fact unconstitutional, and Parliament was given 24 months to remedy the constitutional defects. And in the interim, they would use interim wording, which would be along these lines. So as it stands, it's basically saying that this public interest override would apply to tax records in these very limited circumstances. But it doesn't immediately mean that we're going to have journalists who can now just go and demand to see the tax records of presidents, former presidents, etc., because it has to be that you've got evidence of contravention of the law, and you've got the public interest outweighs the harm, and you've also got protection mechanisms whereby the person has the ability to launch counter arguments and so on, and all of that has to be considered before the tax records would be released. So it's interesting in that it looks as if it's going to sort of lighten the secrecy provisions, but there will be substantial controls that would go along with that. If we look at the SCA judgments in 2023, we had this interesting judgment on Coronation Investment, which dealt with the controlled foreign company and whether the income from that controlled foreign company should in fact be excluded from Section 9D or not. Now, in this particular case, SARS was successful, and it's caused huge issues for Coronation. I mean, there was a substantial impact on their share price, and because they've had to now raise this provision for taxes, which could run to, I think the latest estimate was around about 700 million rand, so close to R1 billion in tax that could well become payable as a result of this. And it all goes along whether Coronation Investment Management's Irish subsidiary could benefit from the foreign business establishment exemption. And it becomes quite a complicated argument. And again, we can't really go into it here, but it really looks at this exemption where there is a foreign business establishment. In this particular case, the Irish company was outsourcing operations, and SAR's view was that because those were being outsourced, they weren't actually conducting those foreign business establishment, or they didn't meet the definition of having a foreign business establishment, and therefore they couldn't access that exemption. And therefore, all of the net income of that Irish subsidiary should have been brought into the taxable income of the South African holding company. And because it wasn't, of course, there was a massive understatement, and there was also an underestimate in terms of provisional tax. Now, in the budget speech, it was stated that the tax legislation is going to be clarified, that to qualify as a foreign business establishment, all the important functions for which a CFC is compensated need to be performed by the CFC or by the other company meeting the requirements above. And that links to, if you look at the definition of foreign business establishment, it talks about the fact that they must have a business conducted through an office, shop, warehouse, etc., must be suitably staffed, must be suitably equipped, must have suitable facilities, and the fixed place of business located outside the Republic solely or mainly for a purpose other than the postponement, etc., of tax. But then it talks about where these functions are performed by another company. And that's the issue, is that what about when they are being outsourced? Well, it's going to be interesting to see. The speculation was that SARS literally wanted to take the judgment from the SCA and bring that into our legislation. We're going to have to wait and see when we get the draft legislation a little bit later this month. I think we'll see it, to see how they propose to deal with foreign business establishments. But it's an interesting one, because coming back to this issue around outsourcing, does outsourcing mean that you are not, that you don't have substance, that you're not actually carrying on that business yourself? And I think that's really the question here. And yeah, it'll be interesting to see what comes through in the proposed amendments. We should see those in a few weeks' time. Then the other two cases dealt with by the SCA, Rapper Resources and United Manganese of Kalahari. Both of these cases dealt with Section 105 of the Tax Administration Act. Now, you might remember from the ABSA case going back a year or two, Section 105, it provides almost like an alternative route to resolve a dispute. The normal route to resolve a dispute is going through the whole objection and appeal process, Section 104, and following those rules that I spoke about earlier. Section 105, though, says that a taxpayer may only dispute an assessment or decision in proceedings under this chapter. In other words, you've got to follow the normal rules of objection and appeal and so on, unless a high court otherwise directs. And so in the Absa case, they were successful in getting the High Court to provide a declaratory order that the commissioner's treatment was incorrect. And so other taxpayers have then kind of followed that route to try and take a shortcut. Instead of following the whole objection and appeal process, rather try and get a High Court order that would give a declaratory order to say, you know, SARS treatment is not correct, and therefore they must change the assessment. However, these two cases make it quite clear that it's not just an automatic thing. It's not just a default of saying, oh, well, I don't want to go the objection and appeal process, therefore I'm going to go for a High Court order. There's a whole process that has to be followed if you want to go the Section 105 route and look at the High Court order. And if you look at the Rapper Resources case, this was an appeal to set aside a decision of the commissioner and to declare the decision of the commissioner to be in conflict with the constitutional. So they were trying to get a High Court order, a declaratory order, to say that the commissioner's decision was wrong, and to order SARS to basically disclose a record of decision in disallowing an objection. But what came out of this case, and it was confirmed in the other case of United Manganese of Kalahari, interestingly, you'll see both of these judgments were handed down on the same day, and both judgments were actually penned by the same judge, Judge Ponnen. And he actually cross-references them, all right, because they're both basically coming to the same conclusion, and that is that you can't just choose as a taxpayer that you're going to apply Section 105 and go to the High Court and get a declaratory order. You have to basically get approval from the High Court first. It says unless the High Court directs otherwise. So you first got to get a directive from the High Court to say that they will consider your application, and only then can you go through the Section 105 process. So both of these taxpayers ended up being unsuccessful because they hadn't obtained the directive of the High Court first that Section 105 was going to be applied. Okay, and then just I've got a list of the other High Court judgments here. Quite a number of them, and I've got a summary of what the dispute relates to over here. I have got some cases that, time permitting, I was going to talk to, but we've actually run out of time because it's already 4 o'clock. So I'm going to just leave this with you and leave the summary with you. And I think I'm going to rather just have to end off for now because I think it is exactly 4 o'clock. And so let's just go through to the end. Those slides you can have a look at. And at this stage, if there are any questions, I'm going to just open the floor. If there are any questions anybody wants to raise. Otherwise, I'm going to hand back to Stan and Danny, and just to say thanks very much for the opportunity to address you this afternoon. And I hope it has been a useful session for you. Okay, so back to you, Stan.
Thanks very much. Very intriguing. Just to let you know that I was auto-assessed. They told me I was going to get a refund, and lo and behold, I got a refund. So I couldn't believe it because they told me 2 years ago that I didn't have to submit any more returns. So I don't know. Anyway, that's there we are.
And you got a refund, so that's nice.
Yes, I can't do much with it, but it's fine. It's better than asking me for money. So thanks very much. Thanks to everyone for joining us today. Jackie, as usual, very thorough and intriguing session. And to those expecting certificates, you will get them in the next couple of days. Please be aware that my Microsoft Outlook email is giving problems. If you do respond, it'll probably come from a Hotmail account. If you do respond, you can send to the email, to the Outlook account, but I can't send from the Outlook. So it's an ongoing battle with Microsoft, but that will be resolved. So once again, thanks for joining us, and enjoy the rest of the afternoon watching sport. You can all have the rest of the afternoon off, so it's fine. And
thanks very much, everybody.
And thank you. Thanks, Jackie, as usual.
Thanks very much. Jackie. Okay. Bye-bye. Take care.